Check 1, 2, check. Thank you. Appreciate that. Happy Friday, everybody. For those of you who are new to the community, welcome. My name is Signet. We're going to be taking you into the close this Friday. You don't really have a whole lot of things that I would anticipate putting a trade on in particular. So if you have something, by all means, give a shout out. We'll take a look at it, see what we could do with it. On the other side of that, since there really isn't a lot that I would want to participate in, I thought that we could at least expand our perspective on the marketplace. I get asked a lot about the indicators that I use. And so I kind of thought we could talk about that a little bit today. Now, throughout this discussion, I want to make it very clear that I'm not talking against any of the presentation people that we have in our community. So Dan, Lucien, Creed, Rose, Angel, however they do things is how they do things. I'm not talking down on what they do. I'm talking about what I do. It is my disclaimer, yes. So you're going to hear me poo-poo on a lot of indicators today. And if somebody else uses them and they do it successfully, then obviously it is for them to do. Okay, so I'm not talking down on anything. I'm only talking about what I do, why I do what I do. So what we watch and why. My indicators are listed on the left side of the screen. The futures indexes, the bond futures, interest rates, XLF, the volatility index, the implied volatility on the volatility index, market breadth indicators like tick, trend, ADS-PD, MMFI, the entire Dow 30, sectors. We're going to start breaking these down into different pieces for the why, but that's what I watch. Just starting with the four horsemen. It's pretty basic. It's the marketplace, the indexes, and the why of this. There's a lot of different whys. Upper left, the S&P. Upper right, the NASDAQ. That's my comfort level. I always have them in the same spot, so my eyes get used to gravitating back to that same part of the screen when I'm interested in looking at a specific piece of information. The Russell is small caps. The NASDAQ is more tech heavy. The S&P would be more of your mega cap or larger institutions or older institutions. And then the Dow. Now, some indexes are price weighed and some are not. A lot of that gets into Dow theory, right? And I'm not talking about the Dow, the index, or the Dow, the company, but talking about the man who created Dow theory. Getting into that is a whole other day for a whole other discussion. But the Dow is an index that's completely different than the NASDAQ and the S&P. The numbers on the end of what you're watching can give you a little bit of a hint. All right, so the S&P is typically referring to the S&P 500. That's 500 markets. The NASDAQ, more often than not, is referring to the NASDAQ 100. It's 100 markets. There isn't an S&P 100. There's a Russell 2000, a Russell 1000, a Russell 3000. More often than not, we're looking at the two. And then the Dow 30 is the Dow 30. There's not really a beneficial edge in looking at the NASDAQ 100 versus, say, any other smaller NASDAQ index you could find out there, or the S&P 100 versus the S&P 500. It just narrows things down or condenses it a little bit. On their own, you could get a little bit of edge out of it, but when you're looking at them in a big picture, you can kind of get an idea, what is the small caps? Well, if you go into the Russell, there's a couple thousand products in there, but you can scroll through and look, and you'll find a diversified index and sector series. There's a little bit of everything in there. For me, I like bank stocks. I like finance, and you find a lot of finance in the Russell. So I know the Russell is not finance, but it does play heavily on the financial markets. I watch it. I get a lot of people who tell me they don't get any value out of the Russell, and probably because they're looking at the Russell all by itself. And you're right. If you take that wandering dog who's usually the last to know and the last to show, and you find it sniffing around bushes and peeing in the grass, that's the Russell, right? We have no respect for it. We talk bad about it all the time. We make jokes about it. But when you take the Russell and you put it into the package, you will be surprised at how often the Russell can give you a heads up on a move. Right now, we just had a sell-off from this top range back down to the bottom of the range, and the Russell gave us a heads up. Count back 3 candles. If you were looking to trade a breakout on the S&P or the NASDAQ from the top of this range right here, you might have decided not to do it if you were looking at the Russell, which was breaking to the downside right then. Nice little heads up, nice little warning, right? All 3 out of the 4 were sitting at the top of a break to go long. Mean reversion would tell you not to go long, but to go short, and you had the Russell there to help you confirm your bias. So I get a lot of value out of using this package deal instead of just trying to look at one of these all by themselves. Now, granted, I've been looking at this 4-pack for over 16 months. And the more I look at it as a package, the more I get out of it. Every week, I get more out of it. In the morning, we can use some of the other indicators that I'm going to be bringing up to help confirm direction in a trade for the open gap, breakout from a range. All kinds of great trades in the first 30 minutes of the day come from looking at the 4 of these combined with some other market technicals that we're going to be looking at. I'm not a big fan of RSI or stochastics or MACD or any of that stuff. Those indicators were built when most people didn't have computers. They were built in the 70s, and there was a lot of confusion about the way traders were doing things and the way that they wanted to start doing things. And people just didn't really have a good idea of what a market looked like. Candles were not common. Retail traders weren't common, right? Everybody was looking at numbers, not candles. An RSI, a MACD, a stochastics, they can't see support and resistance. Since a lot of what I trade is a package, they can't see the package either. Think about the SPY. SPY has Apple and Microsoft and Facebook, and it's got all these different products inside of SPY. Well, if Apple is having a bad day, it's going to drag SPY down. The RSI can't see what Apple's doing if I'm on a SPY chart. The MACD doesn't know what Apple is doing if I'm on a SPY chart, and yet SPY is absolutely going to affect Apple, and Apple's going to affect SPY, because sometimes stocks affect the futures, and sometimes futures affect the stocks. We can't just say it always does one or it always does another, because the market doesn't do always. The only always I've been able to identify in the marketplace is that you're going to lose money. That's guaranteed. It's the only 100% that we have for a fact. So my indicators have to come somewhere else, right? I want something that's giving me a picture of what I'm going to trade. And for me, more often than not, that means I'm going to trade futures, and I need something that can give me a picture of what's going on in the S&P or what's going on in the NASDAQ. Those indicators that I named, they can't see the market. They can only see the chart that you're on. And then how do you know you got the settings right? Should those settings be adjusted if you're on an intraday? What about if we had a major move in the market? Does the indicator understand that? What happens when your price goes into a resistance area or is coming into strength? It doesn't know any of that stuff. It's completely blind. So it's going to mislead you, and it's going to lie to you, and it's going to confirm things that you could easily confirm on your own without it, and on your own see a bigger picture of what's going on. So I don't trade with indicators from that perspective, but I do need indicators. We all do. Volume is an indicator. Price is an indicator, right? I trade really good without candles. I have to admit, I really am getting very comfortable at not having a candle on my screen at all. And that's how I trade options more often than not. I'm getting better at futures doing that as well. But candles are an indicator, and they're really good. The bodies, the wicks, the patterns that they create, but those things are not absolutes. So when you see a bear flag, that's not a rubber stamp to immediately trade a short side breakout, right? What it is it's telling you you should anticipate with a high degree of likelihood that something's about to happen, right? And then you start adding on other things that help confirm that your anticipated pattern is playing out. When you start trading with that perspective, instead of believing that the pattern is giving you some truth or some trigger to take a trade, you're going to really change your P&L. So after the four horses, we got the bond futures. I like the 30-year bond, ZB. There are a lot of different products that you can look at when it comes to futures and even in the bonds. And I used to believe that these were inverse products, that when the bonds went up, the index futures went down or vice versa. And that's not true. And I found that out by watching videos made by Tasty Trades. Tom Sosnoff did a whole series on this. And what they ended up proving is that through time, sometimes the market is correlated and bonds move with the futures, the index futures, and sometimes they're not correlated and they're inverse of each other. So since I'm a new trader and I've only seen them inverse, I believed that that's what they were, right? But that's because I didn't look far enough in the past. Right now, in the last few years, and even right now, they are inverse. But this isn't a forever deal, and sooner or later that's going to change. And there's days where you see them all moving in the same direction, and it's not unusual at all. But when you think of bonds, the easiest way to wrap your head around it is think of government debt. With election season going on and everything else, we hear a lot about government spending and people getting on each side of the fence and, oh, what are we going to do with this debt that we're passing down to our children's children? That big debt, that's bonds. And that's bigger than banks. right? Bonds trumps banks. I hate to use that word. Let's use another word. Bonds beats banks. Paper, rock, scissors. The gold sold off last week when it should have gone up. It should have gone inverse, but it didn't because the banks owed a lot of money, and they needed to cover their debt. So they had to sell their own gold to cover the losses that they had sustained last week, which is why gold went down when the market went down last week, because they got their collective butt kicked. Typically, we would expect gold to go up when the market goes down. It's a safe haven product, typically, but it wasn't so safe last week. But bonds are a really good indication of what is happening in the financial market. When bonds are going up, that puts pressure on the banks, holds them flat or puts them down. And if you take the collective bank marketplace to the downside, it's going to take the rest of the collective market with it, right? Without banks participating in a rally to the upside, we don't get a rally to the upside. We end up with one of those days where none of the markets are correlating. So I keep my eye on the bonds, not tick by tick, but just looking for the general direction of where the bonds are going in the day. Are they up on the day? Are they down on the day? Are they putting pressure on the banks? Because when the pressure is on the banks, then I know I can't rely on the financial sector to help us sustain a move in the marketplace. And I can anticipate that my futures trading is going to be choppier than hell, and that I might just decide to sit out or wait for correlation. So it's a great indicator to just tell me to go do something else today, or to set an alert and walk away and just go do something else. Sometimes playing defense, which is what I do really good. I'm really good at sitting on my hands and just saying, you know what, I don't need it. So a lot of traders have that FOMO really kick in, and oh my God, it's moving. I got to get into this market that's moving. How can it move without me? I have to be in this thing. And they just get chopped up because we don't have any direction. But that's kind of subjective too, not having direction. Because if you're scalping, 2 ticks is all the direction you need. Interest rates is another one. And I got to admit, one of my biggest weaknesses comes from the Forex market and dealing with pairs trading and interest and the effects of the dollar on the market. I got a long ways to go, but I'm okay saying that, right? I don't know everything about everything, and I have a laundry list of things that I still want to learn and understand more about. And my weakness right now comes from FX trades, from pairs, and understanding currency. I just don't, and I need more, right? But I still watch, because even though I don't quite understand it, it's something that needs to be on the radar. I know that zero interest is a really, really bad thing. I don't know why I know that, but when all the other countries in the world have gone to zero or below zero interest, we hear about it on Bloomberg, and they poo-poo all over it, and they talk bad about it, and it just seems like that'd be a bad thing. So at the very least, watching which direction our interest rates are moving kind of gives you a perspective. And one thing, if you're asking yourself what you want to learn, listen to the news on Bloomberg when they do an update, one of those 30-second cuts in between their skits, and ask yourself if you understood everything that they just said, and if you understood why, out of the whole 30 seconds that they had to talk, they focused on those things and shared it with you. One of the things they talk about are bonds, interest rates, the dollar, the futures. Why? Because it matters to a lot of people out there, It should matter to you. XLF, it is one of the sectors, but it's been broke out because of Don Kaufman. He pointed this out, and credit where credit due. I did not notice this on my own, but after he pointed it out, I've adopted it, and it's now a part of what I do. If you draw a line at 26.5, that is like a big line in the sand, kind of a do not dare or don't cross here. When the S&P is having a hard time and the XLF gets below 26.5, buckle up, because it's about to get a lot worse. What we're looking for is a close of the market below 26.5. So you don't need it on an intraday basis. It doesn't matter what time frame you're looking at, like from a 15-minute or a 5-minute. It's on a day-to-day basis. So at the end of the day, are we above or below 26.5? If we're below it, that's going to put a lot of pressure on the S&P from the financial side of things. How he came up with that particular number, I don't know. The guy spent his 12th birthday on the floor of the New York Stock Exchange. Third generation trader. He built Thinkorswim on the options trade tab. He worked with Tom Sosnoff when they were building Thinkorswim. When I say the guy knows his business, he knows his business. Now, I don't know why that number matters, but it does. So I watch it. I watch to see if we're below or above that. And I use that for my overall bias or perspective in the market. And it's not something I have to stare at all day. Just need to glance at it. Where is the XLF? Are we above or below? Are we going to make it back above or below in today's trading period? And what's that going to mean for me next week? Right? And so it's on my list through the day. The volatility index. Volatility is something that a lot of people struggle to understand, not because it's a complex beast, but it's changed through time. The calculation and the formula used has changed throughout time, and our way of using it, meaning our being the marketplace, the way the marketplace uses volatility has changed. This is an imaginary thing. It's not real. You can't go out and purchase volatility. Yeah, if you trade oil futures, you can get a tanker, or you can owe a tanker of oil to somebody, or coffee, or lean hogs, but there's no possession of volatility that you can take, and it's not real. It's an agreed upon formula. Now, the formula can get a little complex, and I'm not going to get into the formula at the moment, but you can read about it. The CME website, the CBOE, they've done a great job of explaining VIX, how it is used, how it affects all the options that are out there, and how the formula is calculated. Now, if you step out of VIX and you go into something else like TVIX, now you're getting into a completely different animal, and it has nothing to do with volatility. Notice the shape of this chart. It has a ceiling, has a top and a bottom. There's no zero ever. It's not going to zero because it can't. There will always be volatility in the market. Always. Could you imagine if there was not volatility in the market? No, because there's no such thing. This is from 2000 all the way up to 2020. There's 20 years here, and along the way the formula changed, but it has a ceiling and it has a bottom. and it mean reverts. So we get volatility and it spikes, and then the situation gets resolved, or we get acceptance with what the situation is. We agree that, okay, we're all going to live. The world will spin for another day, and the volatility goes back down. Not only does that give us great trading opportunities, but that is how options are priced, all options. But if you get into something like TVIX, this is not made by the marketplace. It's made by a company, Credit Suisse. They own it. It's theirs. Just like SPY belongs to the company called SPDR, Spiders. And just like Vanguard has their version of this, and all the different trading firms have their own. This is owned by Credit Suisse, and this is not an ETF. It's an ETN. Notice the shape of this chart for the last 10 years, since we can only go back that far. That's as far back as it goes. There's only one direction. Now, when this gets too small, they're going to get rid of it, and they're going to bring in a new product. They will retire this one, which is what they did to the one before this one. They retired it, and then they brought out a new one. Every night, the value of this gets reset because it's supposed to move at a certain percentage. And every day, that percentage has to be reset. So taking a swing trade in this is a really bad idea. Trying to use this to gauge volatility in the market, it's a really bad idea. We don't know what the formula is. Now, you could go to Credit Suisse and you could crawl through the math, figure out exactly what the hell this thing is looking at, but it's not volatility, and it's not the volatility formula. So what is it measuring, and how can I check it? Well, welcome to the community, buddy. In the upper right corner, you'll see a big power button, like leave session, and then you'll see the rotating circle, and then you got session controls, and then next to that is it's a big rectangle, and if you click that, you should see my name showing Signet. Yep. Hey, Dan. What's up, buddy? So this indicator, which is what this is, the TVIX, it's an indicator. It's a good indicator on an intraday basis, but you get absolutely nothing out of it if you don't understand its formula. Because what is it indicating? Where did the formula come from, and how can I use that to anticipate anything? I can't, because I don't even know what it's calculating. Add to the fact that Credit Suisse hires these people called APs. APs are authorized market participants, and they're allowed to buy in bulk or sell in bulk the TVIX to change the value of TVIX to get it, quote, in line with where they believe it should be. So you can day trade it and make money, because candle patterns are candle patterns, but it's absolutely no gauge on what the volatility is in the market, or where people are worried about their money flow, their insurance, or anything like that. With the VIX futures, I look for a couple of different things, but the main number one overriding factor that I look for in here is I want to see when things are normal. It's what we call contango. Anything with a date and a price tag connected to that date has backwardation or contango. And contango is what we have normally in the market. Things that are closer to us are cheaper, and things that are farther away in time are more expensive, because crops could fail, ships could sink. We don't know what could happen in the future to change the price of that coffee. But we know in the near term, coffee shouldn't have too much of a danger, right? Tornadoes could wipe it out or something 3 months from now, but in 3 weeks, maybe not, right? So typically things closer in time are cheaper. Things farther out in time are more expensive. That's contango. That's normal, everyday market behavior. When we're not in contango, when things that are closer in time are more expensive than things that are farther away, that's called backwardation. And it's a really big red flag telling you that people are more concerned about their immediate marketplace than they are of what could happen 3 months down the road. When it comes to volatility in the market, that is a really great way to gauge how serious people are about protecting their assets. So if you see the VIX volatility futures bid up higher, closer to you than farther away, it's showing you that people are right now immediately concerned about their portfolio and they're buying insurance right now, not later on down the road. We were running a backwardation of around $4 for the last week and a half. And we go back and look at the chart on the ES for the last week and a half, right? Give it the 10 days through this mess. You can see why they would be a little concerned. And it was a $4. Look at that. Through this mess, right? I got that big bar there to remind me when all of this started. From that big bar until yesterday, we were running a $4 backwardation. I wanted to point this out because it was staying really, really steady at about $4 through at all of this. When it got really bad and people, we were all pulling our hair out, $4 is as bad as it got. Now look at it today. When we go in and look at the VIX futures, we want to look at the active contract. And then typically, since Thinkorswim only shows this many, look at the closest one. It's the J for us. It's April. So 1 month out, just 1 month out. That was running at $4. Right now, through all of this mess, if we do a little rounding, we're still there. It's not any worse, right? And it's going to fluctuate a little bit. If we call that 39 and a quarter and this is 32 and a quarter, then we're pretty close. Now we're getting some spikes. So call this 39, call this 32. We're at $7 now today. And we no longer have that $4 gap. It just doubled today. And yet our VIX, we go over to the VIX, when it was sitting at 50 last week, we still had that $4 contango, that $4 backwardation through all of the mess. We're at the same levels today, but the backwardation is twice as great as it was just because of today's price action. Now that's a very serious way of gauging the market. It's solid, it's real, it's not arbitrary. You go outside with a friend and look at the clouds. One of you might see Mickey Mouse and one of you might see Goofy. It's very subjective and arbitrary. But one thing I like about looking for backwardation and contango is it's not arbitrary at all. These are solid, real numbers that you can point to and you can measure every day. You can write them down and look at it again tomorrow and ask how much did it change? What does it mean to me? People just got really, really upset today We know that because it doubled in size. That's a real thing. It's quantified. So I look for these. And I don't really care if it's at 30 or 20 or 50 or 90. I just care how far apart they are. And I want to keep track of that distance so that when I'm trying to figure out if this level of fear is broad market or if it's kind of narrowed into a specific sector, I can come over and look at the VIX futures. If it's broad market, we flip over into backwardation. And when it gets systemic, the backwardation broadens out. It's a lot wider, like it did today. Not something we have to stare at all day. Just want to glance at it through the day and recognize where it is. Market breadth indicators. These have also been around forever. I did a blog on these. It was one of the first blogs I ever written for the Bullish Bears. The tick, trend, advanced decline, and the 50-day money flow, the money flow index. Each sector has tick that is recorded. And you can go and you can read all about tick, and you can look at cumulative tick through the day. You can use it a lot of different ways. Sometimes it's really helpful. Some days it's worthless. Yeah, I mean completely and absolutely, utterly worthless. You get no value from it whatsoever. You really don't know when one of those days is going to be a good day and when it's going to be a bad day. But if you're in a trade and you are watching tick and it spikes into an extreme and you have the ability to get some risk out of your trade, it would be a really good way to let you know to get some profits. Just get out. Get some money off the table. So here's a tick chart. By itself, it doesn't look like much. I prettied it up. I heard somebody say putting lipstick on it. So I guess that would apply. Made it pretty. So through the day, just glancing at it doesn't really give you too much, right? If we're sustaining in the green all day, then we're having positive ticks most of the day. And if we're sustaining in the red, then we're maintaining negative ticks all day. And if we're crisscrossing, then we get a day like today, right, where we're all over the place. So we don't, not a whole lot of perspective there. But if you're in a trade and you see it spike up into these extremes where it come up into 1,000, this can give you a heads up. Like right now, we're literally at this moment spiking into an extreme on the negative side. One, it's letting you know that the marketplace is pushing hard to the downside. People are not just having resting orders to go short, they're reaching to go short. And it's also letting you know to anticipate a pause in the market. Not a reversal necessarily, but the market is about to stop moving to the direction that it was going. If this was green to the upside, that would have told us to expect the market to stop moving up. It was red to the downside, it told us to expect the market to stop moving down momentarily, not forever, momentarily. And it did. It reached those extremes and this move ended momentarily. It's an old indicator. And like I said, some days it's going to be completely worthless and it's going to let you down and break your heart, make you cry. So don't lean on it all the time. But if you're in a trade, especially like a scalp, and you're wanting any warning or anything that could let you know to hang on or to get out, sometimes we need a little help to stay in the trade, right? We get out too soon, leave all that money behind. We get mad because we just stayed in, we could have made more money. This can help you stay in, right? Sometimes we stay in too long and the price comes back, wipes out our gains. We get mad. If I'd have just got out sooner, could have kept my profits. This can help you get out sooner. Sometimes. I don't use it when I'm in a trade, but I do use it glancing at the market overall as a whole on the day. Are we sustaining a green or a red, or are we just coming back and forth, crisscrossing this thing like crazy? And that'll be as much as I need out of it. ADS PD. Now, we could just do the AD. That's the advanced decline. The lipstick indicator is tick. Tick is just tick. But if I show you tick, which is this without the lipstick, it looks like that. That doesn't really give you, so look at that mess. You know what I mean? That mess doesn't look like anything. Like, what do I do with that? But if we put some lines on there, right, kind of like putting lipstick on a pig, kind of clean it up a little bit, then we start to get some value, right? And all I did is I used my drawing tool to draw lines at 100 and 200 and 300. And I went to 1,000 in each direction. And then I just drew a box, made one box red and one box pink, put lipstick on a pig. Each market has this. This is the New York Stock Exchange. You could get the tick for Russell or the S&P or the NASDAQ. All of them have their own tick. But universally speaking, this is the common tick that everybody uses. And if you search on the Bullish Bears, you'll find the blog post that I did write on this. And Lucien, I'm going to give credit to Lucien, but I don't know if he was the one that did all the work. He made this website really, really synchronized. So you can search for anything. And there's years worth of material here. So this is really important. I know it doesn't seem like, yeah, so it's got to search. You don't understand. There's so much material here, right? And it needs to link to something. Everything has to link. So if you come into the Bullish Bears website and you search for tick, you're going to get what I wrote and also what other contributors have brought to the table as well. Here's mine. And in this blog post, I shared a couple of tick indicators because, of course, we can break it out. We don't have to just look at the tick chart. We can turn it into an indicator. Here's the 4 grid of the New York Stock Exchange and the Russell and the S&P and the NASDAQ. If you keep scrolling down, there's the indicators that I shared. And then we get to cumulative tick, another indicator that is also shared on here. So the advanced decline, it's also a market breadth indicator. We use, I say we, ADS-PD. This is the advancing and declining issues of the S&P 500. And I know that because I can see it. It tells me. The advancing issues minus the declining issues. The difference between those two numbers, that's what the ADS-PD is going to show me. And this is another one where I put some lipstick on it. And these numbers, they matter to me from a context of where we're sitting. Where are we? Right? And I'm going to put this on a multiple day so we can kind of just see more, right? When we're at minus 400, I'm really looking for a reversal in the market. Mean reversion says normally we don't, if we push that negative, I'm looking for a reversal, right? These aren't normal days and this isn't normal time. So we can't lean on that right now. But typically, if I see us holding a negative 400 on the day, I'm looking at tomorrow's trading session and I'm thinking up day, you know, but not right now. the same thing happens on the other side. If we run at 400, especially if we open at 400, I'm looking for us to leave the day. If we open at 400, I'm looking for the market to fall. Usually it's to close a gap. First thing off the gate. A gap fill. I love to trade the gap fill. When I was trading regular products, say Apple, Microsoft, I didn't like gap. That gap sucked. It was such a horrible way to trade and do business. Hated it. But when I trade futures, oh man, I love the gap. The gap is amazing. So when we open the market at 400 minus, I'm looking for a market to go up. If we open the market at 400 plus, I'm looking for the market to go down. Not all day, just to close that gap. Just that real quick trade where you can nail 15 points in 2 minutes and you took 6 ticks of risk. Good day. Doesn't always work. Here's a really great example. Right? We've been running at negative 400 all day. In fact, we started at -3 and dumped down to -4. But this is unusual times. A lot of what we would normally do gets thrown right out the window in this mess. In the end. But if you bring it up and you're wanting to look at a couple of things, where is it? Is it in the positives or is it in the negatives? If it's at a -100, you can expect a strong negative day all day long. It's just a sustained negative day. If we're at a +100, you could anticipate a strong positive day all day long. Correlation through the market, 80% of the S&P running to the top side, just a good strong day in the market. A crossover between those two, a lot of indecisions, maybe might just get you to back off and say, you know what, forget it. I'm going to go play Tetris or something, right? And then when we're in the extremes, thinking about tomorrow. But again, it just doesn't apply to our current market. And then also during the day, look at it and ask yourself if you can see any trend. Now, you don't need any indicators on this. You don't want to put a stochastics or a MACD or a VWAP or anything like that. You want your eyes to tell you if there's trend. Let your 5-year-old tell you if there's trend. Bring the kid in and ask, is that going up or down? If the kid can't answer you in 2 seconds, it's not trending. It's not going up or down. If you can see it in a moment that it's moving up, it's moving up. If it's moving down, it's moving down. And just use it to glance at through the day. Where are we? And where are we headed? Is it easing to the downside? Is it slowly grinding higher? So a good indicator, really good indicator. Trend is a calculation based on tick. It really, that is so antiquated. I don't even know anybody that uses it. There are indicators for it. Even here on Thinkorswim, it's a market breadth indicator. And this is taking tick and it's doing a mathematical calculation on that. And then the negatives, the numbers from that are supposed to give you some indication of market. So when this is going up, you expect the market to go down. It's inverse, and inverse always screws with people's heads. But if you see it trending to the upside, you would expect the market to be trending to the downside and vice versa. I don't really like trend. When I was newer, I was trying to run trend and tick and AD, and I would look for convergence between the three, that they should all line up and give me signal. And I would get strong market moves in tick to the upside while trend was telling me we should be going to the downside, and while AD was sitting there crisscrossing around the 0 line. It was really frustrating. Now you could get something from it, but we can say that about anything. Even RSI, even stochastics, MACD, any of those, you can get something from anything. I don't get anything from it, but I wanted to bring it up because it is still used. It's still referenced a lot, and you don't need an indicator for it. It's right there on your Thinkorswim. Just put the $sign in. Hey, Nadine. Thinkorswim has a lot of indicators. A lot of indicators. Now, these repeat. You'll notice that there's like the S&P 500 tick, and then there's the composite tick, and the Russell tick, and the Russell composite, and the NASDAQ composite. So a lot of these are just the same ones, right? There's tick, there's trend. Then you can get into put call volume, put call ratio. I never could see how put call volume and put call ratio gave me any edge. And then I found a video by Tasty Trades. They did a lot of back testing, and they proved that there is absolutely no connection to put call ratio on anticipating market direction. And that made me feel really good because I couldn't freaking see it. And I thought, man, I suck. Everybody uses this thing and they seem to like it. How come I can't figure out how to use it? I couldn't figure out how to use it because it doesn't work. There is no connection to put call volume or put call ratio on anticipated market direction. So if you've heard people use that as a reference, ask them some questions and figure out what they're doing, and make sure that they tell you that it's profitable with what they're doing. Explain to you how it's profitable for them with what they're doing. We're at that 2911. For everybody who doesn't know, that's a gravity point. Should add that to the list. Gravity points. So I don't have put call ratios on my list of things to watch because there is no value in watching them. The Dow 30 kind of takes us into market watch, which is good enough because I'm headed in that direction anyways. I used to build my own watch list. I took the best options markets out of the S&P 100, out of the NASDAQ 100 and the Dow, and then I kind of winked at the Russell, and I built myself around 250, 300 products watch list. Wasn't bad. I've kind of gotten away from that quite a bit. What I watch now is the Dow. Pretty much what I trade now when I'm not trading in the futures. This isn't the only thing that I will trade, but for the most part, if I'm trading, it's probably a Dow product. At a glance, you can use the Dow as a wonderful indicator. Where are we at? We're in distribution. It is a red day, right? Risk off, as they like to say. So you can see market correlation in here. Are we moving as a group? Are every sector and industry moving to the downside or to the upside? Are we testing resistance? All of that can be seen right here, which is really nice, right? It's not subjective again. We're not back out there looking at the clouds trying to find Mickey or Minnie. We have a very definitive answer with numbers. Very clear rubber stamp, have a always next to it. The market is not wishy-washy today, even a little bit. Not at this point in time, looking at the Dow. We're headed in one direction as a group. When you spend a lot of time working with the Dow, you get kind of comfortable with the sectors that are in it. at a glance, you should know these names. You might not be able to name them if you're not looking at this list, but any name in this list, you should be able to see it and say, oh yeah, that's Cisco, Walmart, Merrick Oil. You should see tech, healthcare, consumer spending, all from right here. Energy. There's more than one in a group. So at a glance, you can look at this and recognize how tech is doing or how the healthcare is doing, consumer spending on the day. You're going to get your odd man out sometimes, right? So Walgreens might have a bad day while the rest of the market isn't. Or Disney could be getting hammered because they screwed up a theme park or something, right? On their own, individually, at any time, one of these markets could diverge. But we're not having that kind of day, right? The market doesn't give a damn about McDonald's sales numbers right now. It doesn't care about Verizon's new 5G. The market doesn't care about anything right now. It's just headed down. So you're not going to get any divergence in here. Now, 3M is standing out. Walgreens is standing out. They're still up on the day. So they're defying the logic right there. I've been busy with schoolwork all day, so I don't know what caused 3M to do this. I don't know. Did it? I don't know. Same with Walgreens. But they are the two that are standing out from the crowd that have nothing to do with anything else. Walmart's running a tight third. But you can see those numbers in there. Banks are having a bad day. Credit, finance, Goldman Sachs, American Express, JP Morgan. They're getting their butt kicked. Visa. So I use the Dow, not just for something to trade, but looking at the overall market. I want to see correlation, and the market correlates. Today's a great example. And when we go to the Market Watch tab, yeah, that's correlation right there. 80%, 90% of the market all doing the same thing, which means all their charts are going to look exactly the same. They should all be coming into structure. They should all be rebounding off of support or resistance. They're all moving in step. Well, a lot of times I see somebody come in and they'll ask a question like, "Hey guys, I'm gonna trade Google today. What do you think of this trade?" Is like, do you have any reason to trade Google as opposed to Amazon? Or any reason to take Apple today over Microsoft? If all four of them are doing the exact same thing on the chart, why Google? Is there any skew in the options that might give you some edge? Is there any reason that Google gives you the better trade out of all four of them if they're all four doing the same thing? What's its beta? Right? So once you start wrapping your head around that idea that when we're in a strong correlated market, instead of watching IBM, I could say out of all of the S&P 100, which one do I want to trade today? Brian asked about dip buyers coming into SPY. I don't have SPY up, but I do have the S&P up. And it does look like we're getting some reversion back to the mean. These lower charts are supposed to be set at tick for me. And then the upper ones are just a time value. That gravity point, 2911 on the S&Ps, I really expect us to stay there. It's called gravity for a reason. So we should revert back and forth across that line through the end of the day. We didn't do that this morning because we had a whole day of trading ahead of us. But now we're getting towards the end of the day. And if we leave this gravity point, I would anticipate we're going to the downside. I don't have anything to point at specifically to say that, except that my target has been clear for a week and I have not changed my target. And that is 2,500 on the S&P. If you're trading SPY, that would be 250. That is where I see us going. Before this market recovers and goes back to the top, I very much expect that we're going there first. Not today. But when it comes to using gravity points, I use them a lot like I use Fibonacci. Quick Fibonacci 101. If a Fibonacci level has been broken, do you anticipate a move to the next Fibonacci level? Right? So very quickly and dirty, we just zoom in here. When price broke the 236 back to the upside, it opened up 382, which means we were going to 382. We got there as well. Took some time, it wandered around, but since the 236 was broke, 382 was our intended direction. We were going to go there. But notice it got there and it didn't break above and close above it, which meant we were not going to 50 until that happened. It didn't happen, so we didn't go there. We came back down in this direction. I treat the gravity points the same way. We broke below 29.11. If we close below 29.11, we're headed to the next gravity point down. That would be 28.41. We haven't closed below that level yet, though. I'm talking about a daily basis. We haven't closed below it today. Through this mess, we haven't closed below it. But if we do today, that's going to open 28.46. So, all right, we covered the Dow 30. Now we head into the sectors. Now, this is something that I've talked about before. I remember when I was newer, me and Dan shared a watch list. He shared his sectors with me, and I shared my sectors with the room, which is kind of what got us all talking. And he watches a different company's sectors than I watch. But neither one of them is wrong, right? We're both watching finance. We're both watching real estate. We're both watching energy. Most of mine are these XLE products that I watch. And he has a diversified watch list. So he's got Vanguard in there. And I believe he's got some of these spiders. And then, let's see, BlackRock, Vanguard, and spiders, I believe, is his mixture of the three. But we're not trading these sectors, right? We don't go in and trade the XLI necessarily. We're watching the XLI, watching the industrials to see what's going on in the industrial sector. So that confused me when I was newer, because I looked at his list and I thought, I wouldn't want to trade any of that crap, right? But the piece I was missing is he's not trading those. He's watching those, right? That's what we're doing. We're not looking for a trade opportunity in XLI or in whatever. The main thing that you want to see here is what is sustaining our move in the market. So for an example, this move down today, we are consistently, persistently moving to the downside. What sectors are helping us? And is there anything that is not playing the game? Well, through the 9 here, the top 3 are offensive markets. It's what we would expect people to trade in a good economy or in a bull market. The middle three are the midline, the defensive and offensive are here. These are the things that we would expect to be traded whether the market was good or bad. People need energy, right? Doesn't matter how bad the economy is. If you're cold, you're turning on the heater. If you're hot, you're turning on the air conditioner, and that's just the way it is. Building materials. Projects that were started in a bad economy, more often than not, they're going to get finished, right? Home, when it comes to this, it gets a little arbitrary, right? I don't work on my home and expand and rebuild, remodel, unless I've got money to spend, and I only have money to spend in a good economy. That's back when I actually worked for a living. So that can get a little arbitrary, but building materials, and then the industrials. And the industrials is like the kitchen drawer that we just throw everything in. Shipping, rail, airlines, all kinds of, we just throw it all in there, right? Anything we can't really classify, throw it in the X and Y. But we need all of these to participate, to sustain a move in the market through the day. So that when you come over here and the market is sideways and you're wondering, why is the market sideways? It looked like we were going to rally this morning. What happened? And you come in and you see, for an example, energy going sideways and healthcare going down while everything else is trying to rally. You can say, you know what, I need energy and healthcare to get off the game, off the bench and into the game. I need them to participate in the market. You can start to watch those two sectors. And when that turnaround comes, the market quits running sideways and finally breaks the range to the upside. You're prepared and ready to take the trade with confirmation because you've seen that all the sectors are now participating. So that's not just something to look at through the day. That's freaking trade opportunity. Doesn't always work, right? Don't you love that? Doesn't always work, but nothing always works. So the IV for options plays, that's really broad. Are you talking about each individual's market's IV or the entire marketplace's IV? Well, that's a good one. The SPY implied volatility, if you look at it, it's the price of VIX right now. So what's the price of VIX right now? $46, I think. I haven't been over there for a few minutes, but I think it's around $46. So the implied volatility in SPY right now is around 46. It's not too hard to figure out. Oops. So we can jump over and we can look at that. Add implied volatility. $52. And gee, imagine that. The VIX is running at 52. This implied volatility, 52.1, is the VIX. So for an options play, you can short the VIX, which is what we did last week, and make money when the volatility goes down, or you can put on an options trade in SPY that will make money when the implied volatility goes down. Here's the problem that we're all sitting with right now, and it's a very frustrating problem. We all intuitively understand that we're not in a bear market and that this market's going to rebound back to the upside. It started to do it the other day. And if you were jumping the gun, you could have taken a really good trade to the upside. I mean, look at the move in this thing. 286 back to, call it 306, right? 20-point move in SPY. Could have. In a short term, could have hammered it. But we're not done in this current situation. I think we all agree, though, we're not in a bear market. We're not in a recession. We're just in a situation. And when this situation ends and this market rallies up, and it will rally up, when you jump into that trade to the upside, while your options are gaining value from the move, they're going to be losing value from the vol crush. That is a fact. And that's the problem that all of us are sitting in right now. That if we take any options trade back up through this, we're going to lose value from that vol crush. So you want to put on a trade that not only makes money because you got the direction right. You want to put on a trade that makes money because you got the volatility right. Which means you want to be the one selling it. That way, when it loses value, you get to buy it back cheaper. The problem with being an options seller is because most people believe that when you sell options, there's only one way to do it. That you go out of the money and you get into an asymmetrical or a lopsided trade holding a whole lot of risk. And that sucks, right? You go, say, the 285, 280. That would be running a delta of 40. I don't like 40. Let's go a little lower. $81.76, $5 wide. My go-to is at least $1 in a $5 wide trade, and here it's $1.50. So I could make $1.50, but I'm risking $3.50. In this environment, that scares me because we could easily, remember, my target is 250 in SPY. So as far as I'm concerned, we can punch right through 276, no problem whatsoever, and I would be in a losing trade, $350. So we need a way to hedge our backside in case the market tanks, while also not missing the opportunity to make money on the upside. The good thing about options, though, is we got options. We can build a trade 3 different ways, more than 3, right? If it goes up, we win. If it goes sideways or up, we win. If it goes up or down, we win. That's 3 ways to play the upside. You gotta love that. You can do the same thing to the downside. If it goes down, you can put on a trade and it will win. If it goes down or sideways, if it goes down or up. So because of options, we can trade any of those 3. The iron condor is a really, 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 really bad idea. I might add one more in there. Really bad idea. So think about that. Think about the iron condor. It's 2 credit spreads, right? One above the market and one below the market. Now, if you could put an iron condor at 340, if you could put one all the way up here for the top of your iron condor, that'd be a good iron condor. So if you can go find calls at 340, then yeah, good call, put on an iron condor. But if you can't get calls all the way up here and you get calls anywhere in this mess here, you're going to get run over like a freight train when this thing gets to moving in the other direction. We made this move down in 3 days. Trust me when I tell you we can make that move up in 3 days also. So if your iron condor is anywhere in here, that's you taking loss. Yep. In this bull market that we've had, the last 23 weeks of this beautiful, amazing rip to the upside, all through that, and iron condor sucked. Now on a Friday to Friday, it was good. We traded the hell out of those Friday to Friday and made money. But if you went 2 weeks out, 3 weeks out, a month out, you got ran over again and again and again and again. Because it was such a strong market that it just kept running over the top of our iron condor every single time, over and over. It was defying its expected move and making more than a 1 standard deviation move month to month. Well, if it beats the deviation, we lose. So I started to look more specifically at how often a market was breaking its expected move, not Friday to Friday, which is normally what I was looking at, but month to month. In the current situation, capping this market would be a very dangerous thing to do, because all of this from 340 to 310, it's no go. Well, actually, all the way down. So what I like to do is I like to leg into an iron condor. I really like this trade. It fits me really well. So the way that you leg into the iron condor comes back to this credit spread that I was talking about here. We don't want this. It's got too much risk in it. But if I straddle the market, if I make this as aggressive as a debit spread, we won't get 50%, but we can maybe get 1/3. Let's see what we can get. I tried the 93, that didn't work. We'll try the 94 and the 89. Still lopsided. Notice the output here. It's $1.80. It's the same thing I was getting way out here, right? So that sucks. Yeah, there's huge volume on the VIX calls, but any strike choice isn't going to really give you any edge, and neither does the time frame. Right now, people are scared and they're loading up on VIX, and the price of those are inverted enough that they're just freaking expensive. Now, we traded that to the short side. We'll go back to the VIX real quick. Take that VIX. Recognize that there's a top and a bottom, a ceiling and a floor, and that will help kind of put things into perspective for you. At $50, look at what happens every time we get there. How long do we stay at $50? We don't stay there very long at all. So all those people that are running out and buying calls, depending on the size of those orders, one, I would say it's a bunch of retail traders who don't know what they're doing. And if it's a really big size, and I mean millions of millions, because that would be institutional traders. If there's millions of orders coming through, then they're trading those calls to the downside. If they're short, they're going long on a hedge. If they're long, they're going short on a hedge. $7 million or 7 million contracts. Because think about it. We could name 4 firms, right? JP Morgan, Goldman Sachs, Bank of America. That's 3. That's good. Wells Fargo, there's your 4th. If all 4 of those institutions believe that things are going to get worse and they need to load up on calls, and each one of them are buying 20 million VIX calls apiece, we could anticipate 100 million call options running through the market today. Easily 100 million. So if you see 50, 70, 90, 100 million call options running through the market today, that would give you a really good indication that something's going on. But if you see 1 million or 5 million or 8, 12, 15, 30, that would be one firm, right? When you look at this and you ask, well, this is a monthly chart, so every candle is 1 month, and we don't seem to be able to sustain above or around 50 for more than a month. We are now in March and they're trading April's calls. Why would they be doing that? And remember, we use calls to go short. Keep that in mind. New retail traders are going to buy a call. Institutional traders are not buying calls. They're trading those calls to go short. They don't want to go long. They want to go short. If we were going to build a credit spread up here, we would be using 55 calls to do it, to take the market to the downside. Looking at order flow in options is misleading when you do not know what they're doing with those options. You don't know what they already own. You don't know what they're hedging against. You don't know why they're hedging. But remember, they are hedging. They won't trade naked like you and I will. You and I will grab an options trade like Apple, and we'll trade Apple long, or we'll trade it short, or we'll trade it sideways. They'll take Dow or Boeing, and then they'll go and look for an inverse or a correlation, and they'll hedge that, say like in Apple. So they're trading arbitrage, and they're hedging. They're always hedged, always. So when they go in and they buy calls, you can't just look at that and say, ooh, they're bullish in the VIX. We don't know that. They might be bullish for the week, might be bullish for the day. But their activity doesn't give you any forward guidance on what to anticipate out of the market just because you see calls being traded in the VIX. So we do have time and sales, and we can go in. We can widen that out a little bit. There's the top 10 biggest trades today on the VIX, quantity-wise. That's some pretty good numbers in here, right? We got 1:30 this afternoon. 75,000 contracts were traded. That's a good number. At a 19 delta. We call that a 20 delta. That's absolutely right, Scooter. That is absolutely right. A lot of times, the algorithms are trading with themselves. They're not trading with us at all. And Goldman Sachs doesn't necessarily agree with JP Morgan. JP Morgan doesn't necessarily agree with Wells Fargo. But yes, absolutely true. There is no such thing as too many buyers or more buyers than sellers or more sellers than that doesn't exist, right? Because the only way a trade happened is because somebody took the other side. Now, at the end of the day, you will see trade order imbalance with market orders, market on close. You'll see a large order resting in the market, say 38 million shares will be resting there at a certain number, waiting for someone to buy them. That's a trade that's not fulfilled yet, right? It's a resting order waiting for somebody to take the other side, hoping somebody will take the other side. But this is a big number, 75,000, 71,000, 47 and 45,000. Those are all big numbers. You could anticipate that to be institutional trading. Yeah, like bag holders, just praying someone takes it. But when you see 300 or 500 or even 1,000, 2,000, 5,000, that's not institutional trading. You know, I wouldn't even say that these 18,000 necessarily would be institutional. Maybe a hedge fund. You know, they woke up Bob and said, "Hey, Bob, you got to come in. You got to come in today, dude. We got to hedge some of this stuff, and we don't know what to do." All right, so one firm called up a hedge guy and said, "Come in and check this out for us. Help us fix it." But these are some pretty big numbers up here. They still don't indicate any bias or direction, though. Especially in the near term. You can see that these MAR 18, MAR 15s, these are long orders. I know they're puts, but they're long orders. So in the near term, the next week or two, somebody could be putting their money where their mouth is and saying, I think the VIX is going to make it to 60. But when you start looking at April 20 on the call side, that's the same trade we did, guys. That's the same trade. We went short in the VIX last Friday using calls in that same number period. Actually, it was a little lower for us. I think we took the 20s because it was cheaper, right? I don't have institutional money. But we did the exact same thing. We traded calls to go short in the VIX. So, yeah, you can use option order flow as a part of what to watch and why. You can. The reason it's not on my list is because it's relatively new to the marketplace, meaning in the last 10 to 15 years. Blocks and sweeps. Now, Creed did a video on this, and you can find it on the free YouTube. It's not in the next level stuff. He went to Black Box Stocks when we were promoting their product, and we had this it wasn't a sale, like a coupon. We had a discount that they offered our community, and they gave us a free trial, and they do sometimes throughout the year give us free trials. And people didn't know how to use it, like blocks and sweeps. What am I supposed to do with that? So Creed did a video on it, and then they've done a lot of videos on it. And you could take a couple weeks for each one of these, and you could build market bias and perspective from that. The reason I don't is I don't have black box stocks. And so usually by the time I get to see the numbers, they're way past any actionable value, right? Like, somebody just bought 1 million calls of Apple. I find out 20 minutes later. Well, that doesn't do me any good, right? The bad thing about trying to look at option order flow is if you're a new trader and you don't understand the way that institutional trading happens, then you don't realize that what they're doing is hedging or protecting a trade. And so you might see that they traded 1 million calls, not realizing that that was a bearish position that they took. This is the trade that we got into last week. It was in the green, making profits while the VIX started to sink. Right now, we're back up into risk. So the problem with trying to trade VIX to the short side is everybody sees that it's going to go back down, right? When we go to that chart of the monthly, we'll just bring that up over here just real quick. You can't miss the fact that every time we get to this level, we go back down. So of course, everybody wants to take a short side trade in this for next month, which means you can't get any value out of the trade. So you go in there and you look at the VIX options, they suck, right? Try to put a credit spread on above the VIX, it's going to cost you around $240 of risk to get maybe $5 or $10 of profit, and that sucks. So this, if we was to put on this 45, 42 underneath the market, well, you can get a good value for that, but who the hell wants to get underneath the market right now, right? So we don't want that credit spread. If we take it to the other side, we can go right at the money, 47.5 to 50, $25 is, that's all the profit. Yeah, that sucks. Nobody wants that, right? So the trick is, how do we trade short in the VIX without having such lopsided risk to reward ratio? And the way that we do that is by building a broken wing fly like this. And what that looks like on the risk graph, come on, you can do it, is this right here. Well, you could absolutely just buy a put. The problem with that is you're going to get vol crushed, right? Your put is going to lose value when volatility falls. You will make money when price falls, but you're also going to lose money when volatility falls. So then your trade is working against itself. You want to either negate the VIX crush completely and only make money when price falls, or you want to make sure you make money when VIX falls and when price falls. That way it's working together. All right? But you could just buy a put. It's the Vega. Remember, when it comes to options, Vega is how much money is applied to that option for every point in volatility. Every point. Now, the point isn't 288 to 289. That's not a point. A point is from 28783 to 28784. That's a point. So for every point that the VIX moves, it's going to apply Vega. If we weren't in VIX, we could go look at Vega. There we go. There's 5, 6, 7. So you think, it's a nickel. Okay, that's okay. I'll lose a nickel. Look at the change of implied volatility for one strike. $6 every time we change 1 point. And between the 50 and the 55 strike, we've got 15 volatility. That's a lot of points. That's a lot of points. $6 for every 10th. $60 for every point times 15 points. Yeah. Will that make or lose more money than price? Well, if I buy this call at 115 and we move $5, I could sell it for 145. So I could make $30 of profit there. I would lose more than that in the vol crush. Now, it doesn't really play out that way because as VIX moves, that number will change. It won't stay at 5 or, at 6. It won't stay through the whole move. But you got to put that into your understanding that, sure, you could buy a put and be profitable buying a put. I'm not saying that you won't make money. But when you trade options, you want to look at ways that everything works as a team. If you know you're going to get vol crushed, why not build a trade that makes money from the vol crush? And then when it goes in the direction you wanted it to go and you get the vol crushed, then you really knock it out the ballpark, right? That's one of those trades where you say, look, I freaking killed this thing. Look, I got it. Because you had everything working together. Besides, look at the price of those VIX puts, right? $1,520. Ouch. That's a little rough. Another thing about VIX that you want to keep track of is, and I'm not going to be able to do this as good as, there's a guy that teaches this, and you'll see him on MSNBC sometimes. I'll have to get his name out of my emails. The VIX is connected not just to the SPY bid ask at 30 days out, it's also connected to the VIX futures. So when the VIX futures are in backwardation like we are right now, that is going to greatly affect the VIX, these options here. It's going to jack things up pretty bad. I wish I could explain in eloquent terms how that's going to screw us up, but I think I would muddy your head without being clear, and I would do more damage than actually teach you anything out of it. I don't think I could explain it clearly. There's a famous quote that says, if you can't explain it to a 10-year-old, you probably don't understand it. So I guess that is just a big flag that says I don't quite understand how the VIX futures affects this because I can't explain it to you nicely. I'll have to get better at that and work on it. But recognize that we are in backwardation, right? And that backwardation is going to greatly affect these options. And that our skew is on the put side still, like the, or not still, but right now. And that's not normal. Normally in the VIX, the calls are more expensive than the puts. That's the way it normally goes, right? And we're not there. We're completely so not there right now. This is completely backwards. But we all can agree, because it's right there in black and white, that when the VIX gets above 50, it doesn't hold that level, historically speaking, and it falls back down. And we just want to make money in the fall back down. We can do it with a put, we can do it with a call spread, or we can do it in a trade like this. Now the call, we've seen that a call spread, $25 a credit and $225 a risk, and nobody wants that, right? It's just a horrible way to do business. This one's not perfect. It's not one-to-one. We're risking $200 to make $100. So risk 2 to make 1. For a VIX skewed options trade, that's not too bad, guys. And that's a locked in number. So the volatility crush is not going to stop you from finding your profit. It would also, in the crush, it will help you to a point get to your profit sooner, but only to a point, because the vol crush is going to flip us back into contango. But these are locked in numbers. This sweet spot here, the 10th, that's an unrealistic expectation. We can't expect to actually hit $22 weeks from now when it would be profitable. But we don't anticipate being at $22. We really anticipate being below $21 before expiration. Now, we put this trade on a week ago. It's still good because we're right back. We're right back in the same levels. When we put it on, we were at $49 and we're at $46 now. So it's still a good trade. I don't know that you would get the same price. We sold it for $201. We need to buy it back. But no, we bought it. Excuse me, my bad. This is an outflow of money. We bought it for $201. We need it to go up to sell it. Thinkorswim and Tastyworks does these different colors, and you can't trust the negatives, because when you have a trade built inside of a trade, it'll really throw you off. For an example here, it's a credit. But if we was to build something, oops, don't use those buttons. Something like this, it'll have a negative debit and it's red instead of green. Debits are supposed to be green. So don't just trust that you see a negative and think that it's long or it's short, or that it's red and it's long or it's short. This is telling you that there are two different trades in here. So it's a debit, but it's red. Got to watch the numbers. Here's a, we'll do a credit. So there's your debit spread green, credit red, and then you get something like that. I wanted a negative in there. You can have a red but green, or you can be in a debit and red, credit and green. So this trade, it's a butterfly with an added option. Makes it a broken wing or a skewed butterfly. I've heard a lot of different names for it. The max loss is set, so you can't lose more than what you spent to get into the trade, which is $201. And your max profit is locked in as well. You can't make more than $99 unless you hit the sweet spot, right? The tent here in the middle, which is unrealistic. And that maxes out at $199. From that perspective, it's a one-to-one, almost perfect one-to-one. For the rest of the market, now we've pretty much gone through the list for the indicators that I watch and why. You could add blocks and sweeps. Just take your time to learn them. That way you're not on the wrong side of that order flow. We didn't hit gravity points for you newer people who might not have heard me talk about this before. There was a convention in Las Vegas in 2018, and somebody showed up at that convention with the formula that John Euler had developed to identify gravity points. And they're called gravity because price is pulled to those levels. It's really unique. We can't duplicate it because we don't have the formula. We haven't been able to find the formula. So this chart was shared with people after the convention ended. And anything up here that has the extra G on it, that's my own lines. I tried to make my own. But anything below, starting here at 6 and down, those are the lines that were shared after the convention on this chart. And we got it in 2018, and we started using it. And we got a lot of value out of it, a lot of trust in these. And they proved themselves over and over and over and over again so much that we really began depending on them. And I value them so much. I couldn't imagine not having them around, which is why when we got above them, it sucked because we didn't have them anymore. So I tried to replicate it. Varying degrees of success. I won't know if they're any good until we continue to use my new lines and see how price reacts at those levels. Until then, they're unproven. We just don't know. But the ones with 1G, those are proven. And we know how well they work. And oh my gosh, they work really, really well. So for an example, when we got it, that failed airport in Mexico, that triggered a volatility reaction in the algorithms. And the short trade systems kicked in. Now, those short trade systems, they have to sell futures to get their delta back to zero. So when we break out of the bottom of an expected move to the downside, they're selling to get their delta trade to zero. Well, the more they sell, the more it falls. And then the more they sell, the more it falls. The more they sell, the more it falls. And it does that until the weekends or until price gets back above, which it gets caught in a loop. So that triggered an event that got us down into this range. And we ping-ponged off of these levels because of those algorithms. And then it just went wild here. Anything in nature can't be contained forever. The market is like, it's like nature. It's the reason dams let water out, right? They have to release the pressure. You can't contain volatility forever. Sooner or later, it's going to explode. And that's what happened. And then we reverted out of it. But these levels, we traded these levels. The first one, no, we didn't. I didn't trade the first one. I didn't trust it. But when we came back to that level, I traded it, and I traded it again. I traded this one too, and I got my butt kicked, right? Because it validated here, and I traded it, and I tried it here, and it didn't work out. We broke through it, fell to the downside. You can't win them all, you know. I like to think we could, but we can't. But these levels have been really good. They've been gold, and we're back into those levels again. So they become an indicator that we want to use. Even if you don't trade them, maybe you just watch them so that you can anticipate our reaction in the market because we got to that level. You can see that price absolutely respects these levels. That there's nothing in here that says it's going to bounce or that it'll hold or that it's a wall or support or resistance. It's none of those things. It's just a spot where we anticipate the market will react and gravitate to. And they're back in play. So definitely want to add that to the list. The NASDAQ all by itself is an indicator for me. If I'm trading Facebook, Microsoft, Amazon, doesn't matter. Doesn't matter what I'm trading. I'm looking at the NASDAQ. So these are roundies. This is from 100 levels, 97 to 96, 96 to 95, 95 to 94. And they're just lines. It's not an indicator that I could load up and show you. They're just lines that I drew with the drawing tool. But look at how price moves through these lines and what happens when it gets to those lines. It reacts to those levels. Before I was trading the NASDAQ, I had never traded futures before. So the NASDAQ was my first shot into this kind of trading. And I was doing something that I had never done before. I was actually getting into the trade at the top. And I was getting out of trades at the bottom. And that's impossible. I mean, you can do it once, and just be like, that was my one-time career of getting in at the top. Of course, I'm talking about going short from the top or going long from the bottom. But I was able to do it more than once. I did it again and again and again, and that's impossible, right? You don't get to do it again and again. And it doesn't always work either. You get your butt handed to you a couple times. But you can put a resting order at a roundie. Yeah. You can put a resting order at a roundie to go opposite of the direction of the market. And you can get a good 10 points, 15 points easy doing that. A lot. Now you can see that in the current level of volatility, we're just whipping all over the place, and so what I normally do doesn't work in the, anything that we normally do doesn't work right now. But consistently speaking, normally I watch the NASDAQ, and when we get to one of these levels, I'm taking it the other direction for a nice quick 10, 15 point move. Not that I think that the market's going to reverse there and go the other direction all the way, but because I anticipate a strong enough bounce, like deflection, temporary. And it turns out really nice. And a lot of times, literally to the wick, like right here, to the wick, if you'd have had an order, you know, front run one tick and got in there for a nice pullback in the other direction, just what, a good 10, 15 points and you're out again, and then you do it again and you do it again. I was getting a lot of those trades, and I tell you, it makes your head get really big, right? Because you're just like, oh, yeah, I can do that again and again and again, until the one time it doesn't, and it runs you over, and it sucks. But stepping back into the bigger picture, you can use these levels to figure out, where are we going? Where did we come from? Right, on the day. So, you know, I get up in the morning, I go in, and I'm looking at the market, and I'm asking the question, where are we at today? Where did we come from last night? Did we hit one of those levels? Are we moving towards one of those levels? And how far away are we, so that I know whether to get in or not? Maybe I want to wait to see how it reacts there. Is it going to deflect hard on the roundy and we move through the day to the downside, or are we going to bounce off of it to, you know, and I can use that for a bias through my entire trading day. It's a great indicator overall in the market. And if we go back to what the normal market looks like, you know, you can see a lot of value in that. Absolutely. So for overall market bias, I use the NASDAQ. Intraday, on a minute to minute or a 5 minute or whatever I want to trade, if I'm in the trade, I'm watching the NASDAQ. I could be in the S&P futures, I'm still looking at the NASDAQ. It's my indicator. Because once we start getting into an intraday time frame, it's got other levels called major levels. I'll zoom into some of these up at the top. Those neon Barbie pink colors are the quarters and the roundies. And when we get to a quarter or a roundy, we absolutely react, right? The 50, the 75, the 25, and a roundy, the quarters. We can anticipate market reaction at those levels. Then the tan lines in here are the rest of the majors: 12, 33, 62, 88. When we get to those levels, price reacts. It's trade opportunities. So it's a great way for me to determine if I'm getting in a trade yet. Say I want to get in the S&Ps. Are we moving away from a line? Are we moving towards one? How far away are we? Where's my trade? Where's my opportunity to get in? What am I going to do? And because of this, I make that decision. No indicator, just a drawing tool. And the current market environment is just very, very hard to do that kind of stuff without getting run over. We wick so far past everything that it's just too dangerous to try to lean on exact numbers and use something as small as 6 ticks. Not in this market. 6 ticks is too tight. But it's a really great indicator. And the nice thing is you can find the NASDAQ on everywhere. I think you could even just go to Yahoo Finance and find the NASDAQ, right? I mean, it's everywhere. So it's not one of those indicators that are broker specific. And then, you know, you get people saying, well, hey, I'm from overseas and I'm not trading on Thinkorswim and I can't use your indicator. Well, you can use this. So when you start putting all of these pieces together, it doesn't matter what kind of trader you are. You could be a scalper, a day trading position trader, a short-term swing, or a long-term swing trader. A combination of these indicators can make or break you when it comes to being a profitable, consistently profitable trader. So I wanted to work through this because, one, this is recorded and we're going to be able to market the hell out of this thing. But two, because the indicators that I use are so very different from what we normally see here in the room. And like I said at the beginning of all this, I'm not talking down on any of the streamers that we have or the products that they use or the indicators that they use to trade the market. They are all proven, consistently profitable people who share with you what they do. If they weren't consistently profitable, they would have failed a long time ago, and they wouldn't be here to share with you. So I'm not trying to say that what they're doing is wrong or that it doesn't work. I am saying that I do it different, and what I do works too. There's been a lot of talk in the news about where we're going and the sky is falling and all of that good stuff. The fear monger, the media, always trying to convince you to go with the flow, and then you get ran over again and again and again. So here on the NASDAQ, I've got the expected move indicator up for next week. And one thing that you should be able to recognize right away is that the market makers are anticipating next week to have more volatility than we had this week. The expected move is bigger. They are more concerned about next week's anticipated price moves than they were this week. They're anticipating that the market could move up or down to a greater extent than it did this week. So we can see that right off the bat. And volatility is a word for people who don't trade options. It's a word that's confusing. But when you hear the word volatility, replace that in your mind with the word movement. So when you find something that has elevated volatility, you know that it has an elevated anticipated movement. Which is why I don't like to scan for things with a high IV and then try to put on a credit spread. It's a bad idea. You're scanning to find a product to trade with a trade strategy that says you don't want a product to move. Glad to see you're making money there, buddy. Good deal. So absolutely, you can trade the VIX. You can trade the TVIX on an intraday basis. Absolutely. Go in, grab these things, take them for a run. I'm not talking against that at all. But the trade that we put on, this one here, is a swing trade. And the hard part about trying to swing trade the VIX when everybody wants to take it short is the idea that the options are skewed the wrong direction on the wrong side, and that we're going to get vol crushed. Oh, you wanted to, if you're trying to replicate this trade, we have 1 21 put, 3 22 puts, and 2 24 puts. It's going to be easier if we just do a picture. Now, I posted this trade on Twitter last Friday. I'm not going to put it back on Twitter again. And it is a swing trade. So this is not just a swing trade, it's actually a time-based trade. If we get to those levels too soon, it won't be profitable. If we got into the market on Monday and the VIX was at 20, this trade wouldn't be negative, but it wouldn't have a lot of value. we need time to go by for this trade to actually mature and make money. The data has to come in. So you are going to be sitting in it for a little while. You don't have to stay all the way until May, but it is a time-based trade. It does need time to go by. And we absolutely do need price to get below 30 at least. Below 30 would be a good start as time went by. Absolutely. But you can see Thinkorswim does a better job at showing it. And we can turn on the theoretical lines, kind of zoom this out a little bit. That's our theoretical profit loss graph, that orange line right there. What I had been showing was the at expiration lines. There we go. Yeah, the TLT's been doing really good, and that goes back into this whole part right here that I had mentioned earlier, where I said I'm really weak in this, and I'm okay saying that because I don't ever want to imply to you guys that I have all the answers or I've got it all figured out or that I know it all. But bonds, interest rates, and FX, pairs trade, dollar values from around the world, the Aussie dollar, the American dollar, the yen. So here is TLT. This is the 20-year bond. Now remember that when we get into anything with time and price, then we can look for contango and backwardation. So if the 20-year bond, man, that's a reversal trade if I ever saw one. If the 20-year bond is going up, what is the 2-year or the 5-year bond doing? And is there contango or backwardation? And what does that mean for us? How can we use that to our advantage? And I don't know. Not with this. I don't know. It's something that you could absolutely put time and effort into. And I promise you would get something out of it. I just haven't. This was doing really good. It was nice and bullish, and I liked it. I don't like a market that gaps. That's me personally. This is, to me, an island reversal trade signal. This is telling me to go short. What we would normally anticipate is for the bonds to be going up right now. So absolutely, yes, that trade bonds long. I just don't like this. Most of my rules, although they do cause me to miss out on trades sometimes, most of my rules are there to play defense, to keep me out of bad situations. And gap up, especially major gap up like this, is a red flag that says do not trade. And the reason I do that, one, mean reversion. Think about stretching out a rubber band. Now, when you grab a rubber band and you stretch it out, your energy is causing it to stretch, but it builds energy also. So if you let go of your energy, the energy that it has built up inside of it kicks in and it whips the other direction really, really fast. That whip is mean reversion. The farther you stretch the rubber band, the more energy it has. If you think of the market getting whipped this far, it took a lot of energy to push price. A lot of attention, focus, market perspective, bias pushed it this far. If people lose any of those and it no longer has the energy to sustain it at this level, the whip back will be just as drastic. And that's why I tend to avoid things that have made parabolic moves like that. And then you got Lucien in your head too, who talks about a market wants to fill the gap. And that's been proven throughout. So we know a market wants to do that too. On top of those, it's no longer in a pattern, right? Normally you've got like a cup and handle, head and shoulders, ascending wedge, a bear flag, a bull flag. Here you have nothing because it's jumped completely outside of pattern. Swing Trade Bots has a trade called the Gilligan's Island trade setup. I laughed at it when I didn't know, it's like, why the heck did they name it Gilligan's Island? Well, they needed a famous island, right? So they used Gilligan's Island. I don't know. But there is an island candle pattern, which is what that is. That's what that's called, is an island. And then they built a trade around it. Backs. That's the wrong one. Logic description. So if we go in and we read what their description is for the Gilligan's Island, we just apply that to island candles. Gilligan's Island. So we got the buy side and the sell side. A stock must gap to a new 2-month high. The bigger the gap, the better. Boy, that sounds familiar. The stock must close at or in the bottom 50% of its daily range, equal to or below the open. So we want a red candle. For the short sell on the next day, only on the next day, sell it short 10 cents below today's low and risk 1 point when you do it. So an entire trade strategy focused on the idea that a market jumped and gapped that high. Now, this doesn't fit the criteria for the Gilligan's Island. We can see it's not in the lower part of the candle, blah, blah, blah. But the idea that there are a lot of trade strategies that look at trading this short. Tastyworks has one called the aggressive contrarian that says when a market has made more than I think it's a 10% move, in X amount of time, you go short. Well, show me my data box. Darn it. There you go. That's a 7% move to the top. And it's not even there anymore. It's already faded down. 5.2. So a lot of trading is counterintuitive. When you see a market going along, you should immediately start thinking about the short side. Not that you should just go out and trade short in a long market. You should be thinking about the short side, the mean reversion, the pullback, because even at the very least, it should be offering you a chance to get in, unless it just goes parabolic. So I had a lot of people asking me in the last week why I picked 2,500 for the S&P futures. Why was that my target? And when we started to rally back up, the questions really started coming in like, hey, you still have that bias? You still looking for 2,500? Yes. Yes, I am. Translate to SPY, that would be 250. I'm looking for 250 in SPY. Remember that SPY and the ES, they're cousins. Just move the decimal points over, and it's not perfect. But if the S&P is at 28, where are we at? 2961, then SPY should be somewhere around 296, right? I don't know because I'm not looking at SPY, but it should be somewhere close to 296 in SPY at this moment. So if I'm calling 2,500 on the S&P futures, then I'm calling for 250 in SPY. That's my target. I believe that we're going to go there before we get back up to the top. 297. That's not too bad. They used to be closer, and for some reason they're not as close anymore. But I think it's because they get to change SPY, or what makes SPY, on a rotation basis. I don't know if it's every quarter or so many months. We could find out. I've just never asked the question, like, when do they get a chance to change it? Because they can't change it whenever they want. I do know that. They are not allowed to change it whenever they want. But the products that they weigh it with, it has some, it's like baking a cake. It's got a little bit of salt. It's got a little bit of sugar. It's got a little bit of this, a little bit of that. If you get the ingredients out of whack, your cake is going to not be a very good cake, right? Well, they're trying to build an ETF product that mimics the S&P, so that you as a trader, instead of trying to trade a little bit of Apple and a little bit of Facebook and a little bit of Microsoft, you could just say, well, I want to trade the market, so I'll trade the ETF. So they're trying to give you something that mimics the S&P without actually being the S&P. But they have to choose how much of those different pieces to put into this thing. So here is SPY, and the top share companies in SPY right now, Microsoft is the biggest one at 5.04%. It has 1.2% of Visa. Not, like Visa has 100% and 1 point of it is here. No, 1% of SPY is made up of Visa. Let's say it that way. 1.8% of SPY is made up of Facebook. Now, a year and a half ago, 2 years ago, SPY mimicked the S&P futures products a lot better than it does now. And I don't know why. I know that Apple and Microsoft have swapped over as being the biggest mega cap company. 3 times in 1 week. A few weeks ago, they swapped back and forth between the two. But their weight in the S&P SPY might not be as good as it could or should be. And that might be one of the reasons that it's not mimicking the S&P futures as well. Could be. Have they changed this weight since we've dumped almost 20%? I don't know. I don't think they have, because I don't know when they get to change these weights, right? So it's a ballpark figure that if the S&P is at 3,000, SPY should be very, very close to $300, because that's what their goal is, to try to make an ETF that does that. SPY is made by Spider, but there is one made by BlackRock and by Vanguard, and all the big companies have their own ETF that they made to try to mimic the S&P. They're not as liquid. This is an experimental product. The Spiders is a company that's been around so long that when the market wants to try something new, they get first crack at it. So the XSP, the SPX, and the SPY are all 3 experimental options products that you won't find on any other options. You might think it's very normal, if you're a new trader like me, to go in and look at SPY and see 3 expirations in a week. And it might not have dawned on you that you can't find that anywhere else. Only in the S&P products. Only those 3 that I named. Now, at some point, there's been a lot of talk that they love it, by the way. They love it. And they just haven't gotten around to putting it on other things. But this, at some point, is going to be on the Qs, IWM, VIX. Who knows what they're going to put it on, right? I mean, they really love it. Think about throwing darts at a dartboard. The closer you are to the dartboard, the easier it is to hit your target. So when you can put on a trade that never exceeds 3 days, you're very close, to the dartboard. When you're expiration date isn't greater than 3 days. Very close. Always SPY. Unless a holiday comes along and jacks that out, screws things up. 3 days is the distance. So they loved it so much, they're going to put it on other products at some point. Everything moves very slowly in the market. Nothing happens. No change happens to the market quickly. So this has been around now. From our perspective, it's been around for a long, long time. But from the market perspective, this is really new stuff. I believe it was 2007, but don't quote me on that because I'm bad with dates. But if you think about it, calls have only been around since the early 70s, and puts came out in the late 70s. So they're very new to the marketplace too. Can you imagine how excited everybody was when they got to start trading puts? Because puts didn't exist, and then one day they did. And it wasn't universal. You couldn't get puts on everything, only on experimental products. Back when they were still drawing charts out on paper. Oh my gosh. Can you imagine even trying to find someone to take the other side of your trade? Like, thinking about the way they did business back then, man, it'd blow your mind up. So one of the perspectives that we use with volatility is, and it sounds funny when you say it, right? When volatility is high, the only thing we expect volatility to do is go down. And we know that's not true. It can go up. We just don't expect it to go up. And when volatility is low, the only thing we expect is for it to go up. But that's not true. We know it can go down. It just ain't going to zero. So your trade strategies should always at least recognize where volatility is at. Even if you can't put any edge into it, you would at least be able to recognize what's going to happen to my option if, because that's an answer that we can get thanks to Thinkorswim. And I'm not a fan of these guys. And I was actually talking with Schwab today because I completed my Charles Schwab account application today, and they called me and they said, you signed up for Active Trader Tools, and we have to pay for those. Not me, they do. They said we pay for this product to work, and if you're not an active trader, we're not really interested in giving it to you, right? Are you going to be an active trader? He caught me at a bad time, so I came out like full sig and gave him both barrels, and I let him know what I thought about Thinkorswim and the fact that I was looking for a new home. I'm looking for a charting platform that I can use to perform technical analysis on the marketplace, and I could actually depend on the damn thing. And it was funny because he asked me like, "What? Wait, Thinkorswim's acting up? Didn't know that. Hadn't heard anything about it. What do you mean it's acting up? What's it doing?" I didn't waste my time trying to explain to him how badly it's been acting up or what it's doing. But this product, as much as I don't like it, I haven't been able to find anything else better. I go by, when it comes to statistics, absolutely 100%. Almost every options trade that I take is a statistical trade. The trade strategy that I employ is called PD, probability distribution, which runs completely on statistics. Quant trading and statistical arbitrage is my bread and butter. The only time I really apply historic levels to an active trade that I'm looking to get into is my earnings trade for the calendars. I always use Campbell's soup because it just makes such a beautiful example to do this. Campbell's soup has a really beautiful ramp. from one earnings to the next. I mean, it's like a picture perfect, that ramp. And I love the trade. It's just such a great trade. And I remember I got in early to one of these trades. It wasn't really early, but instead of it proving to me that it had started the ramp up, I got in before that proof. And I got in, make sure I'm on the right year. Let me back up, 2018. Yeah, it was this one. So I got in to my calendar trade somewhere right around in here. And things was looking good. The trade was doing fine. We had just started this climb to the upside, and I came in and my options trade had lost a lot of value. A lot of value. Like, what the hell happened to my trade? Well, I don't let something like that go. I want to know what happened. Why? Why? So a part of what I was doing to find it was I turned on historical. Because I could not understand why my options had lost so much value so quickly without a move in the market to go with that. This move is what happened. These two levels crisscrossed each other. I no longer get into the calendar for this ramp back up until these have crossed each other. Now, here, I didn't have to worry about that. Here, I didn't have to worry about that. But I got into this trade when it was still way up here. And when they crossed, the value in my trade got drop kicked. Lesson learned. So it depends on what you're doing that you need to turn something like that on or not. Right? I don't look at historical volatility typically, but when I'm about to get into my calendar, I do. This particular calendar, by the way, for an earnings trade, when volatility is low, I get into the calendar. And then as volatility rises, the window to be right gets bigger. It expands because of that volatility. And that gives me edge in my trade. I can be less right and still be profitable. So I wait now for this crisscross. If I don't need to wait, no problem. I'm good to go. I'll take it. But I will no longer make that mistake again. But I don't find any edge in just looking at the historical volatility. Now, there is an indicator that will put that at the right level because let me back up for a second. The white line that you see, that's forward volatility. That's 30 days in advance. And the purple line that you see, that's backwards volatility. That's 30 days behind this, right? So neither one of these are the quote right now volatility. The next thing that we have to recognize and understand is that this volatility, the white line, that is 1 year of plotting, right? Like say you take a moving average and you put a 20 period, then it's looking back 20 points. The white line here is saying between now and the next year, we believe Campbell's Soup will move up or down 38% from its current location. 38% from $53 right now in the next year. And to get that formula, it looks at all the options that exist for Campbell's that are out of the money. All the puts out of the money and all the calls out of the money. And then it divides that by however many that it added up. When we go and trade options, we're looking at a specific series. So the March 20 options here, 14 days out, this expected move of implied volatility is only looking at the next 14 days. And it's saying between now and the next 14 days, we could move up $3.17, or we could move down $3.17. And to get that number, they took all these puts out of the money and all these calls out of the money. And then they do their mathematical formula. And it takes like the square root of the year divided by, it's a hell of a formula. I've got it written down somewhere, but it'll just hurt your head trying to use it. Let the broker do the math. So neither one of those are looking at the same thing. And then you've got your options statistics down here. The IV percentile, that's the rank. That's IV rank. I wish they would just freaking call it IV rank. When I was new, I looked everywhere for that damn thing and I couldn't find it. I just didn't know that that's what it was. So your current IV percentile, that's your current historical rank. And our current rank is there. So those two numbers slip by a lot of new traders because they just don't realize that they exist and that's what it's looking at. Coming back to this, there is an indicator. What's it called? I think it's called offset. What the indicator does is it pushes price forward or backwards as much as you want. And I always forget the name of it until I need it again. Displace. Yeah, displacer. So if you take the displacer and you set it to implied volatility, and then you can set it 30 days. Now you've got historic volatility right now, right? Because historic volatility is 30 days behind us. Implied volatility is 30 days in advance of us, or a year. So if you use that offset, it's supposed to give you like the right now. Now, the only thing I don't like about this is it just doesn't, it's not catching all of the math that we just went through, right? Because the white one is doing a formula for the entire year and looking ahead of us 30 days in advance. And the purple one is taking the entire year's calculation, and yet it's showing us what happened 30 days ago. So how are we supposed to split the difference with that? Just by offsetting this backwards 30 points. Well, that doesn't suit me, right? So instead, what you can do is you can use the other button. It's hidden here. I got to turn it on. Product depth. Now the market's closed, so these aren't going to move. But if the market was open, you want to set this to options and not futures. That's what futures looks like. So set it on options. Choose the series that you want. We'll go with the calls, because that's what we're interested in, right? The move back up. Let's go to SPY and make it worth our while. So here's SPY calls. And it defaults to all series, but we only want to worry about MAR 20. That is the implied volatility into the close for the call options for the MAR 20 expiration. All of the options. Now we could choose how many strikes we want. 4 strikes, that should be 2 in the money, 2 out of the money. 6, 8, blah, 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 and then all is all, right? So you can see the right now volatility for the options that you want to trade. And I mean like the right now. One of the things that's really frustrating about Thinkorswim is that it doesn't chart for you in a way that I like, that I'm comfortable with, the implied volatility through the day. Now you can do it a little bit, kind of. So if we go into those March 20s and I picked the 298 call, I can copy that And I can go to the charts, paste it. This is the candles for that particular option. That's how much the option gained or lost value since it was made. And then we can apply options. Option delta, gamma, theta, vega, even theoretical option price. I know those are hard to see, so I'll make them darker. So on an intraday basis, you can see what's going on with that option, but it's just one option. And I don't like how Thinkorswim makes you go in and chart that particular option and not be able to see a lot of the options, right? Or all of the options, even just for a series. How did the implied volatility change on the MAR20 options today? Overall, as a group, did the implied volatility go up? Did it go down? Did it not really change at all? And then, how much did that change the expected move? Those are really important pieces, and they don't show us those pieces, and I don't like that. It's not their fault. I mean, you know, it's not like they're skimping on us, because that's not what they're doing. But if you go in and you use this scratch pad and you start the day focused on an options chain, just pick a series, say MAR20s, because we're all really looking at the MAR20s a lot lately. And when the day started, if you write down the at the money strikes and you go 2 in, 2 out, right? It give you 5. So 5 strikes. Just write down their expected move for the whole series. So that series would have a 47.92. And that equaled 22.87. We'll round up. If you do that in the morning and you do that at the end of the day, you would understand if they priced something in. Because if at the end of the day it changes and it goes down to, say, 45 implied volatility, and the expected move didn't move, you'll know that they priced something in. They do it all the time. We don't see it, right? We don't see it, but they do it all the time. And the reason we don't see it is because if you don't write these numbers down and it changes, you've missed it. And it's like, oh, crap. Did it expand today? Did it go down today? And the key is the relationship between these two. I watched a video once that said for every point in volatility, it equals 1/16% expected move. So when you do the math and it doesn't equal that, then you know that they've priced in something. But I went back looking for that video now that I have a stronger understanding of options and trading. I've never been able to find it again. So I don't know if that number is accurate or not. But I know that if you look at the number at the beginning of the day, and then you look at the number at the end of the day, and if you make this a routine, picking a series, probably the monthly, right, which is the MAR20s, and then April 17. And that way you can just focus on the monthly one. And you start to notice when they're tricking in or adding in or pricing in volatility to the market. It can really give you a heads up on what the market makers believe is going on in the marketplace, but it's not charted somewhere. There's that thing that you want to look for is the ratio between the implied volatility and the expected move. How much did it grow or change? So after you write these two down, you would want to get out the calculator. $22.87 and divide that by 47.92. That is your split. Keep track of that. At the end of the day, do the number again and see if that number changed, if it got bigger or if it got smaller. So that's one failing that Thinkorswim has. You don't get to see that number change through the day. Even just for the whole series, I mean, that would be great. Other than this, I mean, we do have that, right? So you can pick the whole series, MAR, just turn them all off and then pick MAR 20. But this, I feel like it's lacking because this is showing me right now at this moment, but it's not showing me what did it look like this morning. And through the day, did it go down? Did it go up? Did those two change in their distance? Some trade ideas for next week. Something that I wanted to touch on, and I was hoping to do it sooner than this, but we'll get there eventually. So we talked about the problem that everybody has at the moment, right? We all want to go long. We know that everything is on sale. It's all on a discount, and we're going to get punished in volatility. That doesn't mean we can't take it, right? We just have to recognize that punishment is there. We also know we're not in a bear market. We're not in a recession. We're just in a situation, an event. When this event ends, and eventually it will, the rally back to the upside is going to be fantastic, and it will rip your head off if you try to cap it in any way. Before that rally comes, we could very easily take a couple more dips to the downside, and my belief is that we're going down here. But I've been wrong before. I will be wrong again, and we might not get down to 250. We almost got there, by the way. 256. I don't hold that because this is the pool of liquidity that I'm expecting us to get before we go back up. And that's why I don't believe we're there yet. Okay. So if you want to trade anything to the upside next week, the end of the week, whatever, we already know that we can't really do anything about the volatility. We want to put on a trade that can make money out of two of the three things that could happen. If the market goes up or down, we make money. If the market goes up and sideways, we make money. If the market goes down and sideways, we make money. We've got choices out of those to go with. Ladders are one way to do that. There's different ways to build a ladder, and there's different name forms like back ratio, call diagonals. Depends on the direction you want to go. The idea is to build something that if the market tanks, it won't hurt you very bad. Maybe even makes you a little bit of money. And if the market rallies, it makes you money. And the only way that you would get hurt, because you can't have 3 of 3, you're going to have to get risk somewhere. Your only risk will be if the market doesn't do anything and just stays sideways. I think we are all in agreement that a month from now, we won't be where we are right now. Depending on the size of your account, you could very easily just go out there and you could just put on the straddle or the strangle. But those of us with smaller accounts really struggle to put on something like this because they're expensive. And you can see, I mean, the only risk here is if the market doesn't move, right? If it goes down, you're good. Goes up, you're good. You stay in the middle, you get squished, right? But that's a $3,770 trade. I ain't got it. Now, I can convert this into something that I do have, but that gets weird, right? Or we can put wings on this, and that would just be weird. So we can go in, I'll do it $5 wide. So from 85, we'll go to 80. And from 85, we'll go to 90. And you might be able to recognize that it's an inverted iron conduit. And we don't ever want to do these. That's what, or it's an iron fly. We don't ever want to do these. Right? You don't want to buy anything that has the word iron in it. You sell it, which I always find funny because I worked in the steel industry for most of my life, oil field, and worked for a steel manufacturing company. So an iron fly looks a lot like this. It's a lot like a butterfly. And we don't want to sell an iron fly because this trade only makes money when price sits still. We don't want that. We expect price to move. So we're kind of screwed in that sense that we can't put on this one. There's no way to change this straddle into something that we could trade for a small account. You can either afford it or you can't. There's no fixing it. And that sucks. Okay, but for you big account traders, this is your trade, guys. This is, pick a product, right? You're at that point in time in the market that we all agree we are way beyond its mean right now. Things can get worse and you'll make money, or things can revert back to the mean and you'll make money. Anything in the Dow right now, not anything, but almost everything in the Dow is primed for this one single trade. If you don't do the straddle and you want to do a strangle, it turns this V into a bowl or a cup. It puts a base in here and it spreads your wings to break even wider. That's not a good thing. It's not a good thing. But the other problem with this trade is volatility. So I'll park my mouse right there and just let you see the numbers. In the left-hand side, in the middle, you've got a bunch of different colored lines. 2 colors are the same. We need to change one of those colors. Too dark. There we go. So this is putting 5 points of volatility into the market. Well, we're not expecting volatility to go up higher. We're expecting volatility to go down. So I need to go up here and put a minus sign in. And now when I stop my mouse, you can see that when this gets vol crushed, and it would get vol crushed if it goes up, it's going to hurt the trade. Doesn't mean it can't be profitable, but it's not working with volatility on our side. If we crash more from this market, volatility will go up more. So that'll be beneficial to the downside. There's just no volatility benefit to the upside. I'm a big fan of the banks. I like banks and I like credit cards, and anything to do with those, I'm a fan. I love it. If we go in here, let me see what I got. I believe I had the bank grid made on this. I'm not at my trade station. I'm at the streaming computer. Let's see. Banks. I thought nice little setup. I didn't make it, but I like it. I can't give credit because I don't know who made it, but I didn't make it. So just point that out. But in this grid, XLF is the sector, the financial sector. And then you've got American Express, CME, Goldman Sachs, Citibank, United Bank, on and on and on. Wells Fargo, JP Morgan, Bank of America. And you can watch all of those, all right? And then pick your trade product. Now I used to trade Bank of America a lot because it's in my price range. I like it. I know it. So I traded this a lot. But I found one better than this. Bank of New York Mellon. And I have found that I enjoy trading Bank of New York Mellon more than I like trading Bank of America. Maybe it's because it doesn't have as many newer options traders playing around with it. I don't know. I don't really have an answer for why the options are better in here than in here, one versus the other. But I like trading Bank of New York Mellon more than I like trading Bank of America. When Bank of America was closer to 45, 40, 50, when it was higher up here, I liked it more. I don't like it this cheap. It's still either one, right? I just wanted to point that out. Either one. So Bank of America. Why it did not have my implied volatility in there. That's the one I was looking for. Yeah, we'll leave it out. So we're going to have to deal with vol crush. Of course, it doesn't matter what we're going to trade. Everything is going to have vol crush. It's got an IB rank of 100. Implied volatility at 66%. Looking at the structure, the best way to look at structure is to just go out to the larger time frame. And you can see we've got a little ways to go for, quote, the lows, but not too much. So we're near something that could provide support if this was to go down. You've got a $4 price target for your strangle to the downside. It's not bad. And then for the upside, of course, it would just be reciprocation back to the top. So call it 7. 7 to the top, 4 to the bottom. So we go in here. 49 days. You could use the April 17, but 24 works too. Take the at the money, buy and buy. We already know what volatility is going to do to this trade, so we don't need that. Set it to expiration. This is April 24, so we need this to be April 25. It is. Need to make sure I didn't jack the date up here. I didn't. Set the slices to 1 standard deviation move. And there is the trade. $4 to the downside. 1, 2, 3, 4. That's outside, or it's inside the expected move to the downside. 7 up. 1, 2, 3, 4, 5, 6, 7 outside. Yeah. The risk really looks to be to the downside here when it comes to the skew. Your break even is 21.92. You could get beyond that, but the idea would be that you want to get there as quickly as possible. The good thing about the downside is if Bank of America was to drop to the downside, the implied volatility would go up. So you'd be sitting up here with that green line, and you'd be able to close your trade with profit sooner. And what that looks like, we can just do it, is we can go in and we can add another 20 points of volatility and just stop our mouse right there. So you can see that profitable trade, 209.14, 50% profit. So that's not bad at all. On the top side, though, this break even, $30. If we get that fall crush like we're expecting, we'll just take that plus sign off, put on the minus sign. There's the break even right there, 30.08, 30.09. We'd be looking at $36 profit. And that's for today's move, right? We haven't moved through time yet. But the main question would be, would putting on the trade work? Right now, anything that's made this massive move down, putting on that strangle would work. Why wouldn't it? We're expecting either mean reversion or a continuation of the fall. What we're not expecting is price to stay where it is. Things that look like Apple, notice how it's already started to move back up. That wouldn't be as good. I mean, could you put it on and be profitable? Yeah. I don't expect Apple to stay where it is, but it would have been better to catch it at the extreme, down at near the bottom. So if you're going through the Dow 30 list, for example, if it's already made a good leg back up and it's in the middle of the top from the bottom, it's not as, to me, it's not as exciting, right? Not just exciting, it's not as anticipated. That's the word I'm looking for. But the other side of that coin would be that if it's already made its move halfway back up, it could easily fall back down to that level. But if it's already at the lows, looking for a lower low from that, not so much, right? So looking at it from that perspective, I guess it doesn't matter if it's at the bottom or not. You don't want to find something back near its top. How's that? That would give you no topside breakout in this market environment. So if you're going through the Dow 30 list and you find anything back near its top, probably you don't want to put on that strangle. See, like Home Depot, 2 days ago, it was back near that top. So you wouldn't have wanted to put that on. But now, current market, it's in between the top from the bottom. That thing could go either way. What we don't expect it to do is stay where it is. So that'd be is good. Now with your Bank of America, it's cheaper, right? We were talking about how the Strangle is a costly bugger and that most of us couldn't afford to put one on. This is only a $400 product, or $400 trade. And you can still hedge this or pay for it is another way of looking at it. Now, the problem with paying for it is the fact that we have no bias. If we had a bias, it would be better. Let's look at that from another example. SPY. We'll just use SPY. No, we need something down at the bottom. JP Morgan. Perfect. All right, so JP Morgan. Suppose I'm looking at JP Morgan and I'm really comfortable with the idea that we're going back up in the next 3 months. Doesn't have to be next week. So we go in and we look at the options for JP Morgan. They're freaking $800. Damn. And the bid-ask spread sucks. But okay, but I want it. I need. All right, so I want to pay for some of these calls, right? But we can do that by financing them with a credit spread. So here's $190 that we can spend on calls. And the reason we want to do that is because these freaking calls are expensive. And if we could go in the money, they would be better. But the deeper in the money we go, the more expensive they are. So to bias, we're looking for the market to go up. And we want an unlimited upside trade. So putting on calls is the best way to do it. We need to make money in the vol crush, which the credit spread will do. It's not going to help us with our calls, but it'll help pay for the darn things because they're freaking expensive. I mean, look at them. So you can do a double vertical. It's supposed to be 2 different trades. So the double vertical is first you put this one on, and then you go back in and you put this one on. They're the same trade, but it's a double. Or you just put on the credit spread. You got $1.90 of credit there. You spend that money by buying the call. There's your trade. Now, if we make the move quick enough, you got unlimited upside either way. But if you make the move quick enough, then you can get some really decent profit and get out of the trade. What you don't want is some day-to-day slow grind, because the theta is going to drag that green line down till it matches the shape of this red line. And anything between 110 and 125 is going to net you $49 of profit. There's nothing wrong with that, but that doesn't, I mean, that's not exciting or even good. We want good, more good. This is a vol crush that I just applied. And you can see that when volatility goes down, it's going to hurt this trade. So in the upside move, the credit spread is going to help, but that needs time. The volatility crush is going to hurt, and that is immediate. Still, it's unlimited upside. And it's $49 of credit. So pretty decent window. All the way down to 110. Now, I went out of the money to get that credit. Way out of the money. But I didn't have to. For that call, if I got it closer to the current price, we'd have to pay for the trade, paying a debit instead of a credit. Let's see, where do we want to be? Let's go 115. But you can see it shortened that shelf, and it brought the unlimited part closer to us. And the closer you get that call, the better off you are, but it's more money. And if you actually start getting in the money, yeah, look at that. So price right now is at 108. That's this line right there. Your break even, we'll just call it 109. And then you're in green, unlimited upside. 138 is back. Even if you just went to 116, back to structure right there. 116 puts you right there. $691 in profit. It says it doesn't have a 103. Let's try a 105. See how expensive that is, though? So everything's a trade-off. This is something I don't see a lot of newer options traders do or even really think about. But you get money in this trade, right? That's what the credit, spend it. You got credit. You don't have to get the call in the same series. So since the calls are cheaper, closer to the money, we've got $1.90 a credit. There's $1.90 with a 113 strike. Brings everything closer. You can get into the trade for just a little bit of money. You got the unlimited upside potential. So a lot of the ways to trade next week or next 2 weeks, I think the sooner the better, would be, and I was trying to do this on Microsoft yesterday. I ended up having to leave to go to town. It took me longer than I thought. I didn't even get it. I didn't get one. The skew is throwing things sideways. I want to put on a long trade that has protection from a dump to the downside. My go-to was Microsoft. This is the first place I started yesterday. And after 30 minutes, the wife started asking me, you ready to go yet? You ready to go yet? You ready to go yet? And yeah, I'm ready, because I'm not finding what I'm wanting to find. So I just gave up. We're in a better position today than we were yesterday. By Monday, I'd really look to find this, but the skew is throwing it off. We need downside protection, and we're looking for an upside move. Now, I want unlimited upside, but if you get rid of that and you just say, I want profit to the upside and limit my downside exposure, that's not hard to do at all. It's not hard to do at all. So you can do like a back ratio. Something like this. Unlimited upside, protection to the downside. Your danger is a market that sits in one spot. That'll be where you get hit or hurt. Same thing with a skewed butterfly, a lot like what we put on in the VIX. So any trade next week that you're looking at with a market as bad as it's looking right now, and you're thinking, well, I want to go long and I want to limit my exposure to the downside, you can do it a lot easier if you cap your upside and don't run with an unlimited upside. It's easier to do on Tastyworks, by the way. You can just grab them and move them around. So if you just start out with something as simple as a butterfly, you can just skew it in whichever direction you want it to be skewed in. Now the idea is to skew it in such a way like that. If it stays in one spot, you get hurt. If it goes to the downside, you have very little risk. If you do it right, you can make it where it's got profit down there. But even minimizing most of the risk to the downside is good. And then you got upside potential. Alex, have a good weekend. These are very expensive ways to trade the upside. Yes, Roger, you're absolutely right. The problem is the market makers know what we know, right? They are thinking exactly the same thing we are. And the market is a very fair and balanced marketplace. So if you get into a trade where you're almost guaranteed to be profitable, they're going to make you pay for it. And they're going to make sure that your payout isn't very good. So that's why we had to kind of trick things around with the VIX. Nobody wanted to buy our credit spread for any value, right? Offering us like $10 for a credit spread, and we hold $240 of risk. That sucks. But it's the only trade we had, unless we got fancy with the options. So the same thing here. Most of the market looks exactly like this, right? To varying degrees. Some of them are kind of in the middle, but most of them are towards the bottom. We're all looking at mean reversion. Everybody is thinking, sure, we could tank some more, but we're pretty close to what most people agree is the lows, and we're all looking for that move back up. It's going to take a lot of buying power. It's the values that we were looking at about collecting credit in those trades. It doesn't change the buying power at all. If you go in and you look at building a credit spread and you use that credit to finance your trade, the buying power is still there. You're just not forking out as much cash. Say for an example, this Bank of America trade here, this trade has an ask attached to it. We need the market to get above $28, and they're willing to pay us for that risk because that's a pretty big ask. The expected move is only 232, and we're putting the trade just barely outside of that. So we're saying we expect the market to make more than a one standard deviation move. And they're saying, if you think so, we'll give you some pretty decent money for it. In the next 7 days, that would be a bad trade. Yeah, let's look at Microsoft, because that's the one I was working on yesterday. And like I said, she wanted to go to town, and I had already told her we would, because I really didn't think it was going to take that long. Really? So I was like, yeah, sure, we'll go to town. Just a second, let me build this trade. And after 30 minutes or so, I still hadn't got anywhere. And the skew is so bad on the options that I just couldn't get one, and I ended up just giving up on it. So with Microsoft, we just start with the chart so we can see where we're at on the low that we need to deal with. The 152 kind of be our floor, and the 190, oh, the 185, 190. God, think or swim. It's getting horrible. 185. $150 and $185. So we don't want that close. We want to back out at least 70. 105 is too far away. So the next series out is June. That's too far. That puts us right into May. It also puts everybody else right into May. Keep track of that. Well, you could just buy a call option. You're going to get vol crushed to shit, but you could just buy a call option. And if you took every single trade just like that, it might work out pretty good, pretty okay for you. But wouldn't it be better if you got paid in the vol crush and got paid for the move in price? And if all it took was just to try to build it a couple of different ways, you could limit your risk and make money in a vol crush and make money in a price move. Or you could just buy the call. One trade, one time, sure, who cares? The trade you want to take throughout your trading career, might want to put a little thought behind it. If we look back at Microsoft, just round up, say we work the order through the day and we get $2, $2, $2, $2, $2. Make 2, risk 3. That's not bad. The ask is that we need to be above 165. So there is an ask. With that credit, we could apply it to something over here. I would say we want to move forward at this point to a 30-day. We want to go in the money a little bit. A couple of reasons for that. If we go in the money, we got a better delta. And the options skew being what it is, we want to get as much as we can on our side. Anything above, I say above, any strikes above the 149 are getting lower in Vega. So we don't want to go too far in that direction. The 150 seems to be about as good as it gets. So if we buy that call, the 150 calls, we're getting $2 off. The credit spread's bullish. Buying a call is bullish. And you don't just have to buy the call. If you want to limit your exposure even more, you can, let's do $5 wide. Do a double vertical. Oh, what do I have going on here? Ow. Turn that around. Ended up with too many calls. Now what do we got backwards? There it goes. I don't know what I did backwards last time. double vertical. Now, the reason it's got that cantered shape to it is because these two double verticals are different time frames and they're not both at the money. So if we take that April 9, 150, 155, you just turn this one off for a moment. There's the first trade. Now it's in the money, which is why there's so much risk down here. It's $10 below the current price of Microsoft. That is the 153 for break even. If you wanted to even things up, you could take it to the 60-65 or even to the 55-60. That would get rid of a lot of this downside risk down here. And that downside risk, that is a horrible risk. I do get that. But we're building it in the money so that we don't have so much of an ask out of the market. The ask falls squarely on the puts. We go back to the 60-65s, build those separate. There's the trade combined. Here's the puts. It's a lot more equal, a lot more balanced. And then here's the combo. Now, I like the double vertical a lot. And most of the time, I don't skew them like this. I skew them equal. So for the calls, we would also be using the 60-65s. So if I turn one of these off, let's just look at the calls. It's not equal because the options skew is so kicked forward like it is. It's 137 to the upside, 330, it's still locked. There we go. 325, 175. So it's not 1-to-1, but not bad. We put the two together. Now the break even, which is the one thing that I look at the most for these trades, is at 163. So we have an ask out of the market. We need the market to go up for this trade. But from there, it's unlimited upside. It does keep going up. $180 was what we were talking about for looking at Microsoft to get back up into its more normal range. That's near the edge of its expected move. We can see what that looks like by turning on the slices. There's the top of the expected move, $279 to the upside today. And as time goes by, if you're above the break even, time is on your side. It will pay you to be in the trade. So the longer you're in the trade, theta will pay you. You'll make more money. Microsoft could take its pretty little sweet time getting back up there. As long as it gets there before April 9, you would have profit in the debit. And then for the credit, you've got all the time in the world, May 15. Both of those have an ask. So if you take them underneath the market, you wouldn't have an ask at all. But there's no downside protection in this trade that we're looking at here. There's no downside protection. Alan, that's really good news. You know, it was one thing that was a lot different for me when I swapped from options to futures was drawing that line and saying, I'm done. You know, not caring about whether I could find another trade, but saying, I'm not going to look for another trade and just saying done and keeping my winnings. That feels so good. because I stopped trading and I would keep what I made. And it does free up your day really well, which meant I have more time for my schoolwork. And so it makes me feel real good to hear you say that things are working out for you that way. What is your options trade on that 175, 180? What market is that? Microsoft? Yeah. Now, I got hit in Microsoft, SPY, Boeing. When the market went down, I lost all three of those trades. Microsoft, Boeing, and SPY. I was long in all three. Now, I got out without getting hit too bad. And because I had a hedge on, my account still up on the year because of the hedge. But I did get hit. Yep. People were asking me, like, why'd you close it? It could turn around. And I really didn't think it was going to turn around. So I got out. Well, I guess we're pretty close to the same spot. I either got out like one of these 2 days, and I'm betting it. I know it wasn't Friday, so I can go look at my journal, but I think I got out somewhere in here. And everybody was telling me you should have stayed in. It could come back. And like, I don't think it's gonna, not in time. And I ate the loss. Time's gone by for you, but the volatility isn't helping you out any at all. If you could get some vol crush, it might help you out, because you need those options to lose value, right? You're in the credit spread. So a vol crush is really going to help. We don't even need to get back to the same levels for you to get out of the really horrible loss side of that you're in right now. The good thing would be even 50% volatility cut would help out a lot. I was in the $5 wide trade. I think you said that you're in the $5 wide. Oh yeah, let's rebuild. Let me scroll up so I can see the numbers. 175, 180. I had the Mar 20, 175, 180s. I think this is the trade that you got, right? 175, 180 put spread in Microsoft Mar 20. Okay. Right now it's worth 420, and I know I didn't get it for that value. I got it for like 3 something, 275. I took it at the money at the time, which meant I was somewhere near $2, 266. So you're down 154, or is it showing you the full loss? Yep, that'd be pretty close. So the idea here is, if we get a vol crush, these options are going to lose their value. If we wanted to trade the puts right now, we'd be paying, $1,285, $1,695. That those values, I mean, they're just freaking huge. But look a couple strikes up. So a $10 move, not even getting us back into the 170s, but just a $10 move changes the value of those options, because we're looking at implied volatility in the high 40s and 50s. That's a great change in value of the implied volatility. If we get vol crushed, The market makers will crush the volatility out of these, even if we don't get any move at all. If the fear subsides in the market on the VIX, if they quit hyping this thing as the next, global event, the volatility starts to come out of these options without any move in the market whatsoever. We can see that happen. And your options are going to decrease in value, which makes you can buy them back cheaper. Well, what I never want to do in a credit spread is try to use any kind of stop or trigger to exit based on loss. And the reason I don't ever do that is because suppose I had got into the credit spread here and on this day right here. So I get in a credit spread on this day, and for 2 days, or the next day it looks good, my P&L is great. On this day, that drop would change the value of the implied volatility by quite a bit, and my P&L would look horrible just from that little move in the market, even though I'm still in a positive winning trade. So if I try to limit my trades with a credit spread because of value, I'll bail out of trades that are still good. Well, the way you figure it out is you got to kind of try to decide for yourself, can the trade still be profitable? Not how much am I losing in it or could lose, because every options trade, we want to think that it's a max loss trade right off the bat. But can this recover from its current location enough for you to take less loss? We know a vol crush is imminent. Look how much they crushed the option. And then news spiked again, and then they crushed it again, and then now it spiked again. And these are just 1 day crushes, right? These are just little flippy flops. If they really think that things start to subside even a little bit, you won't need the full move up to get rid of some of that loss. And that's what I would hang on to. Now the problem is if you're in a big trade, I mean, say you had like 10 of these, and 10 of those are that's just numbers that kind of freak me out, right? Because that's a lot of risk. You might want to look at that and say, all right, I'm gonna have to take some of these off, because 10 is just too many. And you might want to close some of those right now at their current loss so that the loss doesn't get worse. But if you're in like 1 or 2, ask yourself if there's anything that you can do in the near term to make up some of that. And I'll give you a real life example of what that looks like. Tesla. Last year, I had an idea that Tesla was going to go to 350. And it was right after earnings. Everything was looking really good. And I got into the trade. So I was looking at 350, and it was right after this earnings. And I got in with an at the money $5 wide credit spread to the upside. Now, we didn't know that it was going to do any of this, So I get in it, and I've got 350 as my target, way up here, back to our levels. And right after, I mean it, man, right after I got into that damn thing, we had like 2 days of run, 3 days really good. I'm sitting on the top of the world. And then this, and oh my goodness. So I traded it down. I had put the trade on in my Robinhood account. So I got onto my other account and I took a short trade. For the next 2 weeks, I went short, and then I went long again, week to week, even though this trade stayed on. And it was for around 80 days out, 80 or 90, my regular go-to trades. I left it on. And I was almost at a full loss immediately when it turned around. I mean, that quick, poof. the implied volatility spiked right there. It was just like, you're at max loss. And there was nothing I could do to the trade, really. There was a little bit of value, but not enough to even close. Like, why close it at this point? I done lost the whole darn thing. I might as well hang on to it. So I traded the bias. I traded the market down and traded it back up, and I kept that trade on. And I ended up closing it with profit at 50%. It worked out. If I had to closed it as a loser, I probably wouldn't have traded it short. And I wouldn't have been focused on it to go back long either. More than likely, I would have just moved on. So I made money down, making the loss in the current account not so bad. And then I made money on the way up. And at that point, I'd covered everything that I had in the entire trade at risk. And I was just sitting in a free trade by that point. And I ended up closing it with 50% profit. So it worked out. I ended up closing it, if I remember right, before the next earnings. I was out of it. So using your bias on the chart when it comes to credit spreads is a lot more valuable than trying to use any kind of stops or anything. But I will give you this little nugget that I learned from Kirk at Options Alpha. And it made so much sense when he said it. I was just like, oh my gosh, I can't believe I didn't think of that myself. So if you're using Delta to build your trades, right? Say you're trying to be very mechanical and you want everything done that's out of the money, systematic, and you are building a 25 Delta. One thing that you could do to set your alert to get your attention and say, look, you need to go take a look at this trade and find out if it's something you want to keep or not. Thinkorswim will let you put an alert on Delta. If Delta is probability and it's also a number that shows our risk in a trade, you might want to know when your risk is increasing to a level that is becoming extreme. So half of 24 would be 12. If we get to 36 Delta, I want to know because my risk has just increased by 50%. So say I got this trade here at between these two numbers, the 24 and the 25. I'll use 24. Set an alert at 35 because it doesn't have a 36. When that alert goes off, it has nothing to do with price. It has everything to do with the fact that my risk just increased by 50%. That needs to get my attention. I can go look at the chart at that time and start checking the news. What changed the value of that option by 50% of risk? Did he tweet something? Did the news change? Why? Because it could be that the implied volatility changed, not price at all. And because of that change in implied volatility, my risk has doubled or gone up by 50%. And that is that's a valuable little nugget. Because when we put an alert on price, we're not paying attention to the things that change the value of that option the most, which are the Greeks. Implied volatility changes the value so much more than price moves. So you can thank Kirk for that one. I don't want to steal it. It will too. Yep. When I get into a trade, I immediately put in my exit order for profit. And the reason I do that is because we'll get vol spikes or we'll get vol drops, vol crush, and you can trigger an exit trade without seeing price move at all. Or the price will move so quickly that you humanly couldn't recognize it, go in and put in a sell order. But if your order was already there and the vol drops momentarily through the day, it can drop you right into your exit trade. I've had trades trigger, and when I look at the chart, most of the time my charts are on like 15s and 30 minutes when I'm on an intraday basis. I'll look at a 15-minute chart and ask me, like, why did I just hit profit? I didn't even see anything happen in price. It's because the vol moved and took me into my 50% profit. And then, it's like, all right, cool, I'll take that. That was a win. So I always put my exit order in right after I get into the trade. I can always cancel it later if I don't need it, or if I need to manage the trade or whatever. A lot of times, right at the beginning of the day or right at the end of the day, the volatility can really get whippy on an intraday basis, and that can get you out of a trade with profit. You can hit that 50%. So it's pretty cool. This IV rank doesn't work on an intraday basis unless I adjust it and get rid of the hide on intraday button. And looking at implied volatility indicator on an intraday basis, it's not an accurate representation of the volatility, but for the moment, it'll do. You can see towards the end of the day, I mean, Tesla moved $15 at the end of the day, but the change in implied volatility, that's a 50-point move in implied volatility. Again, not an accurate representation of volatility, but still. When we were talking earlier about one of your daily habits should be to monitor by writing it down the change in implied volatility. If you pick a strike and you write it down at the beginning of the day, it's at 109.73 with a 125 expected move. And then at the end of the day, go back and look, did it go up or down? And how much did the expected move change with that move up or down? That way you can spot when the market makers are pricing in something. That language used to confuse me. I would hear Bloomberg say it. I'd hear it all the time. Oh, they priced it in. What do you mean? What does that mean? They priced it in. How, you know what I mean? I'm like, how did you find that? And that's how you find it. Is there's no market metric to say that every X amount of vol equals 1.5 amount of money. So we have to watch for that on our own. And since there's no chart or level to show us through the day, the vol did A, B, D, whatever it did, and how did that change the expected move? So, but we just write it down and then go back and look. And the alerts are great. You can use them both directions. It'll absolutely work out just fine. I really should just build a chart of this and save it so I don't have to keep rebuilding it. I had a student that was wanting to day trade options, and the best way I could get him to visualize the value of the options on an intraday basis was to put him into option charts. Because in our mind, we see the option going up when price goes up and going down when price goes down, or the put side going down when price goes down, making money. But that's not how the option really moves. So if you actually just plot the option in a chart and then put the real chart next to it, then you start to see that real correlation between the two. So here's the option today on SPY, and here's SPY today. So in this leg up, we can see how that call did. And in the leg down, we can see how that call did. So you can actually start to see that real difference between the two. Options are tricky little buggers. You could get a dollar move up and a dollar move down in SPY, and that option won't go, say, 25 cents up and 25 cents down. It'll go like 30 up and 10 down. They're not equal or fairly balanced at all. And then when you start putting it into a spread, everything gets even more out of whack. But this number here is some serious numbers. The Vega, the application of Vega, because of the move in implied volatility, man, the way that that affects the options is so extreme, especially when you get very close to expiration contracts. 12 pennies per Vega. And my misunderstanding was that for every point of volatility, Vega is applied. These MAR 9s have a 37.49 vol. So I used to think incorrectly that we would need to go to 38.49 for that Vega to be applied. And that was incorrect. That wasn't true at all. $32.74, $37.43. We'll just look at those two numbers right there. $37.43. With a 12 penny move. And that strike, 296. That's the 296 strikes. So my mistaken belief was we'd have to go to 38.43 for that 12 cents to be applied. But nope. If we go to 37.44, we gain 12 pennies of Vega. So when we go to trade SPY, for an example, and we're looking at a $1 move, if we buy the call for 481, we get a $1 move, we sell it for 521 for easy numbers, 60 cents on the dollar. Heck, that's not bad. The implied volatility, though, that change in implied volatility, that's the money for us. If it doesn't change in the move, and we know that it would, right? So those numbers they're not stationary. They're going to move. But if it just stayed right there and moved, that's a big difference. 80 points almost. $0.96. Of course, like I said, it won't stay static. So we wouldn't get 12 the whole time. It would move and adjust. But when you start talking about volatility in the market and its effects on our trades, this part of options trading used to get me all out of whack because I would try to do that kind of math and hang on to the values in my head through a shift like this. And I was like, well, the numbers don't play out. If that's the $1 move that I'm looking for, and it's only going to make me 60 cents, how could the change in the volatility be 90 cents? Right. And so those numbers would get my head all out of whack. Just throw all that stuff out and just focus on the final number. Remember that the final number already has all the math applied. Yeah, and the pocketbook. The final number already has all of that done for you. So in a $1 move, you're making 60 cents on the dollar. That's not bad for an options trade, 60 cents on the dollar. And you're risking 70 something cents. So that's not good. Normally, when you take just a flat option on SPY at the money, you typically are looking at a 2-to-1 risk reward with no stop needed. It'll typically show like 60 cents to the upside for a $1 move and 30 cents to the downside if you're wrong in that $1 move. A pre-built risk to reward ratio. But the skew is so jacked right now that the calls are more expensive than the puts, and we're in an inverted market. So those numbers aren't playing out. It's why options trading right now for people new to the market, especially if they don't have any exposure to the bullish bears community, they're really at a disadvantage. Last year, in the swing trade room, we spent a lot of time crawling through the Greeks, and I got very comfortable with people in the community speaking geek like we do. When I found Discord and I got into a couple of Discord communities, I found out that most people out there don't speak geek at all and barely have any understanding of options trading, period. You guys are really pretty spectacular group of people. I can come in here and speak geek, and you guys are following along with what's going on. You might not have step-by-step understanding, but I'm not losing you in the crowd. And then being able to apply these metrics into your own trading in the future, man, that's amazing. New traders right now, or people new to options trying to trade in this mess, they're donors. They're complete market donors, and they have no chance in this market. They're going to get lucky on accident, or they'll take the naked call. Oh, I'll just buy a call. I mean, it's only 80 cents. And it will be profitable, right? You can buy a call and trade this up. Yes, of course you can. And you can find profit anywhere along the way. Yes, you absolutely can. But it would be better if you could get paid for the vol crush and get paid for the move up. And it would be even more better if you could do all of that while also limiting your downside risk, so that if it dumps, you get hurt less. That's about as good as anybody could ask for. Downside protection, upside profits, and your only real risk comes from a market that just stays put. And I think all of us don't expect the market to stay put. And so that's the one thing we all agree on, is that we're not going to do that. All right, guys, I'm going to get off of here, go get me some propane, and I'm going to cook me a porterhouse for dinner. It's been that kind of a week. Alan, thank you for sharing your success. It's been a week where a lot of people that I talked to didn't have a very good week. They really struggled with the volatility in futures, and it wasn't a good week for a lot of people. So I'm glad to hear that more people are successful, because it was starting to become a current theme on the week. Keep hammering at it, and that's just good to hear. Sounds good. I'm sure I'll be there. I've got some homework that's going to keep me busy. Got a paper due, but that means I'll be on the computer, so definitely be there. For anybody looking for some homework over the weekend, try looking at ways to build yourself a trade to the upside that has some downside protection. Now, it doesn't have to be profit to the downside. It could just be something as simple as this, where the downside risk gets limited, reduced in some way. There's a lot of different ways to trick these options around. If you have Tastyworks, you're going to find it a lot easier, because you can just grab these and drag them and move them all over the place, and it just makes it very easy to do. I mean, look at that. Bank of America. I've got downside protection and profits, upside profits, and my only risk is right there in the middle. Nice and easy. And the max loss, because the market's not open and things aren't moving anymore, the max loss is my debit, what I paid, $87. It's not bad. So there's a lot of ways to put this together. So if you're looking for something to do, that would be figuring out ways to do this. And then think about how the volatility is going to affect the trade, and how it could help you get to your profit sooner, or how it could work against you. We're going to get vol crushed. That's a given. If you got any questions, throw them at me on the Discord, or send me an email. My email is in the room drive. I don't check email as often as Discord, because Discord kind of pings like a text, so it's pretty immediate. All right, I'll see y'all Monday.